Good morning, everyone. Deanna Langman here with the Montana Procurement Technical Assistance Center, or PTAC as we're commonly known. I'll introduce our first speaker here in just a minute from Left Brain Professionals. But before that, just a couple of things about Montana PTAC, if you don't know already. We are specialists in helping companies with government contracting. PTAC is a program that's national in scope, funded by Department of Defense, and all we do all day long is help companies find, bid, and win government contracts. We know how all the systems work, all the steps, the processes, et cetera, where to find the opportunities. And so we are here to support your company in its government contracting efforts. PTACs, like I said, are all over the country. All the states have PTACs. In Montana, we have 6 locations: Billings, Lewistown, Great Falls, Kalispell, Butte, and Missoula. And we have some of our advisors on the phone. On the call today. Rosalind is here with me in Billings, and she helped coordinate all this event. She did all the work, actually. So thank you, Roz. And I think we've got Lisa on from Kalispell, and I can't see all the other screens. So if you're PTAC, just give a wave. But anyway, no matter where you're at in Montana, there's a PTAC advisor to help you with government contracting. So after this webinar today, keep that in mind. MontanaPTAC.org is where you can find all of our contact information. Okay. So with that, I'm really happy that you signed on today, because this is excellent information. You know, I've had the chance to sit in on a couple of different workshops with Robert over the years, and he is a specialist, and so is Stephen, in government contracting accounting, and it is a specialty area. And so they're going to do a great job for you today. And it won't just be spreadsheets and numbers. There'll be plenty of that, but I know they have some interactive exercises planned, and I think you're going to be very happy you spent the time this morning. You're going to walk away more informed. So with that, I guess the other thing would be questions. The idea would be to answer questions after each section. And so put your questions in the chat. Is that right? Is that what you guys want to do?
Correct. And I would encourage folks, type the questions in the chat as they come to you. If we can address them during each section, I will try to do that. But because of our 4-hour time today and keeping all of this into that window, I would like to not have, raised hands and conversation until the end of each section.
Okay, great, Stephen. Well, Stephen Bressler, he has spent nearly 9 years in government accounting. He has assisted in the management of federal funds from HUD, with all the regulatory provisions that come along with that, the accounting standards and the revenue streams. He's also got 8 years of experience in private and corporate accounting. And so he is really a specialist in his field, and I'll let him tell you more about the company and the agenda today. So thank you, Stephen, for spending the time with us today, and take it away.
All right. Thank you, Deanna. First of all, I want to thank the Montana PTAC for having us come out. Left Brain Professionals, who we are a big boutique accounting firm, and that only works with government contractors. We specialize in accounting systems and strategic services. All we do, eat, sleep, and breathe government contracting. So that gives us a very specific expertise. We do not prepare taxes. We suggest that our clients maintain their existing tax CPAs. Robert Jones is our firm principal. He will be doing 2 of the 4 sections today. I am kind of a compliance and transactional specialist, where I'd work with the system implementations, the adequate accounting systems, and all of the compliance issues that come with that. And then Robert will, the strategic side, the audit support. He is a NCMA fellow and very, very knowledgeable. So without further ado, we will get in. This slide here is just highlighting our practice areas. Not that we both don't do all the projects, but I'm kind of more on this side where he can do a lot of this side here. And we will both be available today throughout the workshop. So if there happens to be a question that I cannot answer, don't be alarmed. We will be switching each section based right around the hour. So there's a picture of us. You may have seen Robert. I am about almost 3 years with Left Brain, so I have been around for a while as well. So our first section today is the fundamentals of indirect rates. I like this one to go first. I believe each section will somewhat build on itself into the next topic. So starting out with the fundamentals of indirect rates, we will dive right in. So our learning objectives today: to list and identify the 5 basic cost pools, describe the composition of each pool, and just real quick, the direct expenses being the cost of goods pool, and then all 4 other are considered indirect pools. And then the indirect costs will be separated into the 4 pools. Identify acceptable allocation bases and methods. So this is a preview as well. Once we have our 4 cost pools identified, there is not simply one method to allocate the indirect costs. We will get into some more details on that, but moving right along. The 4th learning objective is to execute the proper calculation of indirects. And then our 5th one is tips for full cost recovery. This will get into ensuring that you don't lose money, as well as some best practice methodology. So moving along into our 5 cost pools. They are listed here. Direct costs, synonymous, cost of goods sold, cost of sales. These are defined, which I will get to the definitions on in the future, but the direct cost, the cost of goods, they should always be referenced or tagged to a final cost objective, which you will hear that term multiple times during my presentation. A final cost objective is a customer, project, contract, grant. So you should have that set up so that you can tag that on your direct cost. Then fringe is the cost of having W-2'd employees, and I stress W-2 because if you have 1099 employees, they do not receive the fringe benefits, being the healthcare and the employer taxes. So that's why the fringe is the cost of having the W-2. Overhead, real quick definition, is in support of sales, but not one specific final cost objective. Really quick example: if you're a supervisor that manages multiple direct employees who work on different projects, because that supervisor doesn't have that one final cost objective, their labor becomes overhead labor. Then G&A, the cost of running a business, that's your accountants, your HR, your executive leadership. And then unallowable costs are our 5th cost pool. These are not things that you're not allowed to buy. They are simply costs that the federal government will not pay for. With that said, in the FAR 31 guidelines, you can read in excruciating detail the items that go into the unallawables. Unallawables can be identified in contract language as well, but for our purposes, the unallawables, you're allowed to spend the money, but those costs are removed from the indirect rate calculations. So now I gave you a quick description on the individual cost pools, but we will have slides to give you details and examples of the each one individually. So the direct costs, aka cost of goods sold, COGS, directly attributable to a final cost objective, which I mentioned. Some examples, now labor, you will distribute your labor between indirect pools and direct. Materials, travel, ODC stands for other direct costs. That may be fees, subscriptions, shipping costs, freight. And then subcontractors, we separate from labor because they are those 1099 folks, whether they be an external subcontractor, a temporary employee. If they are doing direct labor, it still must be tagged to the final cost objective, contract, CLIN, project, customer. But because they do not receive the fringe benefits, they are put in the subcontractor section instead of the labor, and separating those helps for the allocation of the fringe costs and the other indirect costs. Okay, so moving along into now, the next four pools are all considered indirect costs. The indirect costs, we would like to tag with which pool they're in, but we don't have to reference a specific customer. So fringe is kind of the most straightforward. The employer portion of taxes. Now that is, I just want to take a moment to identify, when you work with most payroll companies, when they give you your 2 or 3 withdrawals for your payroll, they are not going to identify employer and employee portion of taxes. So at the end of the day, in a proper labor distribution, the employee portion of your payroll taxes is part of your gross labor. Because you're paying your employees, whether they're, have deductions or things taken from their pay, their gross labor amount should be recorded at the rate that they are being paid. Overtime premiums would be separated from the base rate and put in the overhead pool, which we will get to. But the health insurance, fringes like employer taxes, benefits, retirement, whether it be and this is only employer contributions. Again, if the employer contributes to the 401k or pension, that is the retirement expenses reported. Contributions made by the employees, again, those dollars are part of the gross labor. And then all compensated absences, PTO, paid time off, holiday, sick, vacation, however you record it, however many different ways you separate, all compensated absences are separated from the labor dollars and placed in the fringe pool. And that goes directly into the rate calculation, because even though the labor dollars are spent, no one is working on any contracts or indirect labor when they're not at work. So that is an example, what makes up the fringe pool, and some examples of the primary aspects that make that up. Now, overhead is a little bit more. We have a lot of questions, which we call 5-minute questions. When you get an expense and it's not direct, it's indirect, and then becomes the decision, is this an overhead expense or is this G&A? So overhead, cost of supporting customers, products, or services. General support, idle time, training, manufacturing services and supplies, and all facilities. And when we say facilities, that does include utilities, rent, telephone, especially, and this is a little bit easier as an example in a manufacturing situation where you may have a manufacturing location that is a facility that is all overhead. But if you have an additional facility where your office or your accountants sit and the manufacturing is separate, that office facility would be considered G&A because it's not in support of sales. But if you only have one office, you can put all the facility costs in overhead because it is used. The one location would be in support of sales ultimately because everyone is using it. Couple of notes on these overhead costs. General support and idle time. That is simply saying if you have an employee who does primarily 100% direct labor, if they're idle or they're meeting, talking about all customers, that labor then becomes overhead because it cannot be attributed to one final cost objective. And training, for very small organizations, I would say most all training can be in the overhead cost pool, but training should follow an employee. So if you have a G&A specific employee, like an accountant, and they go to some accounting training, it's that cost can be put in G&A. So the rules that we highlight at a high level are these topics are overhead, but the one exception is that cost will follow an employee. So if an accounting person who doesn't do any direct labor, any customer support is doing training, it can be the exception to training being in overhead. Then on to the G&A pool, general and administrative. That can be confusing because in some industries like construction and A&E, they don't tend to separate G&A and overhead. They just have one, they might call it the overhead rate, but it's really one rate for G&A and overhead. So we recommend to separate and use all 5 cost pools. So G&A define the cost of operating the business and cost incurred regardless of the number of customers. Just like I mentioned, business development, accounting, human resources, IT, as well as your professional services, your legal, your consulting, things of that nature can be considered G&A costs. Now, the basic setup for your cost pools from direct all through the 4 indirect pools is 1 direct pool, 1 fringe, 1 overhead, 1 G&A. But there are situations where you can have multiple overhead pools. A good example of that would be like an engineering and manufacturing firm. Engineering are basically, professionals certified in their profession, have a computer and probably an office, where manufacturing can have a lot more facilities cost if you have machinery, a facility. So in that case, where a business hypothetically had engineers and manufacturing, there may be a benefit or a requirement, not a requirement, a best interest to have a engineering overhead and a manufacturing overhead. Or if you have an on-site where you work with a government in a contracting setting, the on-site overhead and the off-site overhead is usually quite different costs. And it's very difficult to apply one overhead rate if your costs are that different. That does get a little bit more into advanced rate calculation. And today we want to kind of do a high level, but if you have questions, and there is a potential for 2 fringe pools in the event that you had SCA or service contract agreement. You can have SCA fringe and non-SCA fringe, because you run into like cash in lieu of benefits, and the fringe benefits for your SCA employees, your non-SCA employees may be a little bit different. But generally, for a service organization, research organization, one of each cost pool is acceptable in most cases. And that's something, you know, the folks at the PTAC, or if we were working, you know, to verify or get accurate rates based on a specific scenario, we may suggest a second, third. We have one client with 7 overhead pools in addition to a shipping and merchandise handling pool. Now this is a larger company, but real quick, the reason for that situation is multiple divisions with very different costs. This client specifically had a situation where they had passed through commercial items and they were adding their overhead rate. So based on the divisions with very high costs, were making their overhead rate very high. And when they sold a simple commercial item with that overhead burden, it became very expensive, where the customers said, you know, this burden is not fair based on this commercial item. So that is a very specific example where they had to have multiple overhead pools just to manage their pricing. Unallowables, moving right along and getting back to our content here. Costs not allowed per terms of the contract or regulations. General examples of unallowable costs. Oh, and we've got a poll question. I'll just take a little breather now for the poll question, and then we'll get right back to our unallowable examples. So we've got some answers. The question being, which of the following is not one of the basic cost pools: overhead, assets, fringe, or unallowable? We've got about half up. Now they're coming in a little quicker here. So it looks like most of your responses are in. The correct answer is assets. Assets are actually a balance sheet account, which the balance sheet items, the P&L items, are what are used to calculate, or income statement expenses are used to create the indirect rate calculations. So do I close the poll, or do I just switch right back to the slides here?
I can roll it. Oh, I got it.
Okay.
There we go.
Let me see here. Okay. Okay, let me get back. I thought I had another slide on my unallowables, but let me just finish up real quick here. The unallowable costs, they are very defined in the FAR 31, the part of the DCAA guidelines that talks about unallowable costs. Examples of unallowable costs: charitable donations, advertising, employee morale. If you have a big party because, you know, everyone did such a great job last quarter, those costs are unallowable. Alcohol purchases, any entertainment. And that's one note I really like to stress during the unallowable section. You may have your travel set up in a way where you have an account called meals and entertainment. So when a contracting officer or a DCAA representative sees the word entertainment, it immediately triggers unallowable. So we recommend a very simple solution. Just don't drop the word entertainment from your meal expense. Oftentimes, if there is meals and entertainment, that will make them scrutinize those costs to ensure that that entertainment portion does not encompass unallowable costs. Our recommendation is to simply have an entertainment account in the unallowables, and the meals, you would want to have a travel meals account under direct, overhead, and G&A. So real quick, and there's our slide that we already did. So now we're going to move through that. We have identified the costs that make up the pools. And now we're going to talk about the way, when you calculate indirects, the way the indirect pools are allocated. So starting with the direct costs are not allocated, but are assigned to their proper final cost objective. And there's that word again, final cost objective. So direct costs are basically oftentimes part of the bases, but they are not allocated because they are tagged to your final cost objective. They are not part of the allocation. So for acceptable allocation methods of fringe dollars, there's a couple of methods here that I'm going to go over. The very most common and recommended is total labor dollars. This, as we will get into further, creates the least variances. And by total labor dollars, it is very important that I stress that is only W-2. Your temporary staff, your subcontractors, anyone on a 1099 basis is not going to be a part of the base of fringe. And when you use total labor dollars, because the compensated absences are a part of the fringe expense pool, they are excluded from the fringe base. So the fringe base is all W-2 labor less compensated absences, because the indirect rate becomes a numerator and a denominator. And if you have the same number in the numerator and the denominator, we all know that that basically voids that calculation. So the next method, which is less common, is total labor hours. There are risks of over or under absorption of costs. If you use your total labor hours, that can sometimes be applicable, like we mentioned, in a manufacturing setting. But obviously, the big difference between dollars and hours is the rates. You know, you have employees, one employee may be getting $100+ an hour, and another person could be $15, $20 an hour. So obviously the hours does create for potential absorption issues, but there are specific scenarios and industries that kind of take advantage of that option. So there are direct labor dollars. Architecture and engineering, construction, I mentioned briefly, is kind of an exception. We actually have separate rate calculation tools for A&E businesses and service or manufacturing firms. So if you would be in a situation for direct labor dollars, they just basically discount the indirect dollars. And like I said, that is very industry specific to the A&E world. Then direct labor hours, the same thing, kind of the same comparison between total labor hours and total labor dollars. If you have varying rates, that can create some additional, and that is which, you know, upon further examination, some industries may benefit from using that method there. Mostly total labor dollars, it's somewhat uncommon to see those others. Moving right along here, we are going to get into the overhead allocation methods. The most common, as you can see, is direct labor costs. Service or high labor industries, your research, your service industries, your consulting firms, your direct labor dollars are a good best practice method. Direct labor hours, again, very similar to the fringe allocation. If the hours for the year can easily be estimated, like machine hours, things like that. And then your direct material costs can be added to the direct labor. If the material costs, like in heavy manufacturing, is a great example. If you allocate your overhead over labor and material in a heavy cost manufacturing, it's just going to be a more accurate number specific to your organization. So in the overhead allocations, it is very much driven by your industry and your specific needs. But most common, I will just highlight, is direct labor. And I'm sorry, I changed that. Direct labor costs, which is just one portion of the direct cost of goods sold. Okay, so total prime, and this is still overhead allocation methods. Total prime cost, this is what I alluded to with the manufacturing. Outside of just direct labor or direct materials, there is a value added to the materials when you put both the labor and the materials, which increases the base. So then your numerator, being the actual expenses, can create a lower rate if you allocate it over a larger base. Then these next couple are kind of manufacturing specific. And like the notes say here, units of production, if it's a high volume environment, can be an alternative overhead allocation. And then machine hours is another manufacturing measurement, very similar to units of production. It would just track the time that the machines actually run. The G&A acceptable allocations, the total cost input is the best practice, most common recommendation. And that is simply all other costs. And we will have some visual examples where we show you the G&A base. Then value added is another option for your G&A allocation. This is in conjunction with material and subcontractor handling pool. Like I said, in advanced indirect rates, you can create multiple pools to get more specific so that you're not adding a burden that includes costs that aren't specific to that activity. Material, shipping, and handling is a great example, because if you're using your regular G&A rate to burden your shipping and handling, it's probably going to be quite a larger percentage than if you just had a material and shipping base. So that gets into a little bit more of the advanced topic, but the total cost input, which will be in our example, is the most common. And then the unallowable cost, as I said, the unallowable costs are not allocated, but some direct and overhead are included in the base of the G&A. The unallowable costs, really the only ones that affect the calculations would be the unallowable labor. Mostly the unallowable costs are excluded from the rate calculations so that they get a calculation without those unallowable items. So we're up to our second poll question. I will ask Rosalind to launch that, and I will read the question while that happens. Which of the following is not an acceptable allocation method for overhead? Units of production, direct labor hours, prime cost, which means material and labor. Or actually, I'm sorry, prime is if you are a subcontractor. Might make a small correction there. And W-2 employee labor. Okay, the answers are coming in here. We'll give you guys a couple more minutes. I am seeing quite a bit of different answers. 40% are saying W-2 employee labor. That D is actually the correct answer because the W-2 employee labor is your base of fringe. So that would not be an acceptable allocation for your overhead pool. That's one note as we do learn and move through the indirect rate calculations. You're not to duplicate. If you have your W-2 labor in your base of fringe, then you cannot allocate other costs over that same base. So I am going to go ahead and share the results here real quick. We did have a pretty good distribution of answers, but as we get through the rest of our presentation, hopefully we can clarify some of that. And I think we will make the video available as well so that you can view those slides if you would like. So now our next section of the indirect rates is the math to calculate them. And I think we're doing pretty good on time, so we will press forward here. I have not seen any questions, but feel free to type them in there if something pops up. So the basic math of our indirect rates is the pool divided by the base, pool being the numerator, base being the denominator, and that will give you a percentage which we would use for the allocations and the burdens to allocate our indirect costs over the appropriate bases. There is no right or wrong answer to say our rates are too high or we need to lower our rates. It is what it is. If you're recording your costs in your accounting system accurately and separating them and pooling them appropriately, and the calculations are compliant, the numbers are, you cannot control what the math is. The rate is the rate. So here is our fringe. So what we can see here in the direct labor, we have all of our costs laid out by pool. And then our fringe pool is made up of only our fringe costs, which is very straightforward. Benefits, employer taxes, health insurance, and compensated absences. So our pool is exactly the amount of those costs. And then in this example, we have used W-2 labor. So you can see we've got direct, G&A, labor, and they are highlighted here in our example. So all this labor totaled together, you can see our paid absences would be reflected on our W-2s, but because they're in the base, they are excluded from the pool, and we get our numerator and our denominator. And our fringe rate in this specific case comes out to 26.61%. Now, fringe can be different based on, how much time off, how much of the healthcare you pay, how much you give to the 401k. But like we said on the previous slide, there is no black and white correct answer. but somewhere between 20 and 40% is what we see. Now we are moving along to overhead for the math. So our overhead pool is our overhead costs. You can see customer support, idle time, which would be when our direct labor staff is not doing direct labor, it becomes overhead labor. And then our applied fringe here is based on the fringe rate that we calculated. And we are applying the fringe on our overhead pool. And then we have our facilities, our overhead, and there's our training. So the overhead actual costs are only 1, 2, 3, 4, 5. And then this fringe is applied based on this percentage that we calculated and included in the pool. And then our overhead is, we have all our direct labor as well as fringe applied to our direct labor. So our direct labor and our unallowable direct labor, you can see over here. So we combined to get our total of direct labor, and then the applied fringe on that direct labor is simply our fringe rate times that number. So I do see a question popped up. We recommend once you close your books, if you close them monthly, quarterly, once you know all your expenses are posted, to check on your rates that same time frame. If you close your books monthly, you can calculate your indirect rates. And when you calculate your indirect rates for February, you're including year to date. You're not just doing just February. You're taking year to date in each of the following months so that you get a calculation of the current year. And then if you have a cost reimbursable contract, you would be required to report your total costs in your incurred cost proposal. And that would be a annual calculation based on your fiscal year. And I need to stress that it's not the calendar year, it's your company's fiscal year. So with that, with the applied fringe in the pool and on the direct labor in the base, you can see we come to our numerator and our denominator, and we get a actual percentage of overhead. So now that we have our fringe rate and our overhead rate, you can see in the G&A calculation, we are applying fringe, we are applying overhead, fringe on direct labor, overhead, fringe, applied overhead. And I wanted to get to this bottom one because this is applied fringe on unallowable overhead labor. So there's basically fringe on an overhead calculation. And we do have a template on our website, just as a side note, where you can put your trial balance in, and it basically uses our best recommended methods and does these base calculations for you. And that is a free downloadable tool that we have. So getting back to our G&A actual math calculation, all of our G&A costs, accounting, business development, HR. Now this would, G&A would include like your general liability insurance, your software subscriptions. And then we have applied fringe on our G&A. And I think it's on our G&A labor, based on the math here, 26.6% of $30,000 gets our pool. And then we have used the total cost input G&A base. And that is, like we said, total cost, direct labor, applied fringe, applied overhead. So we're applying fringe and overhead on our direct labor in our G&A base. Then we're adding our unallowable labor, the fringe on that labor, and then overhead on the direct labor. And that is this unallowable direct labor. And then the unallowable overhead labor with fringe on the unallowable overhead labor. So this is kind of a simplified calculation, but that is our total cost input G&A base, which creates our numerator and our denominator and gives us our G&A rate. And you can see in the unallowables, these costs, even though they are considered unallowable, we are assigning, if they were allowable, we identify which pool they would be in. And you can see the total, it just makes sure that that amount is deducted from these other calculations. So this is, as I alluded to, our downloadable, and it has been updated. This is just a picture, but that's a link there. And like I said, that is a free tool that is available. And we are coming up on our third poll question. Fringe is typically allocated over all labor, including temporary and subcontractors, direct labor only, W-2 employee labor, or direct and indirect labor. And everyone so far is, I can only assume you're paying attention. We'll give you guys a few minutes here to get your answers in. And without further ado, the correct answer is C, the W-2 labor. Now, we do say all labor, but it does not include temporary and subcontractors because the 1099 staff or subcontractors do not receive the fringe benefits. Okay, so I'm going to share the results. A majority of us did identify the correct answer there. And in the sake of time, I am going to press forward here. Okay, so full cost recovery. This is the last portion of our first section here. Hopefully you guys are hanging in there and absorbing some of this all of this information that's coming at you. So here goes back to the first question that we had in our chat. Review your rates regularly, monthly. We really recommend that you build budgets. Later on in today's workshop, we will talk about budgets and give you some tips on how to do that. But you want to track, your actuals in relation to your budget. And it is 100% okay to update your budget quarterly in the middle of the year. If you planned on winning an award that didn't come through, your budget, is nothing at all wrong with updating or keeping your budget accurately as your year moves along. And then that's my second point here. Adjust of the budget quarterly. You may just have made some assumptions in the budget that didn't turn out to be accurate, and there's nothing at all wrong with updating that budget. Full cost recovery, continue. Over and under billing. Once you do have your rates calculated and you see your invoicing, the incurred cost proposal is the ultimate reconciliation of over or under billing. We may not talk a whole lot about that. That is that annual report due 6 months after the end of the year if you have a cost reimbursable contract. But as you monitor that billing, that ensures that your pricing is accurate with your indirect rate calculation And also that you've been using the accurate pricing, because if you do identify over or under billing, you may have a requirement to adjust your pricing. Update the billing rates when you write your budget. And I know with your contracting officer, you want to get your provisional rates submitted, hopefully in the November area of time, so that they will actually approve your provisional rates, so that you can, technically you're supposed to wait until they're approved to use them. But we find the DCAA is not always the most quickest organization. And many of our clients will, at the start of a new year, use their provisional rates just to cut down on the over or under billing, even if they have not gotten around to approving them. And then these are the things that you'll look at as your billing and your budget moves along. Differences and variances in those initial calculations. So in conclusion, higher margins and improved profitability are the direct result of proper calculations of indirect rates and the maximum recovery of all costs incurred. That is something I'm stressing. Not just building your rates, but if your rates aren't in compliance and built accurately and specific to your organizations and scenarios, that can all affect your potential pricing or underbilling. And then by one of my other favorite terms besides final cost objective is total cost recovery. If you're not calculating your pricing accurately, and your indirect rates are not reflecting what's actually happening, you run the risk of not recovering all your costs, or, just billing the direct labor and not accounting for all of those indirect costs. We are within about 2 minutes of my time. So this is our last poll question for the first section. And then we will give a small break, and Robert will take over on the next section. So without further ado, how accurate are your indirect rates? Perfect, good, horrible, or we have not calculated. Some of these polls kind of help us as presenters to where if we get the feedback of where you are, we can kind of gauge the information that we provide to your specific needs. So it looks like people are either don't have indirect rates or they're pretty comfortable with them. So sounds like we've got a nice range of needs in our audience today, and hopefully you can take some benefit away from our information today. All right, there are the results. Nobody thought theirs were perfect. And even the most veteran contractors, you're always monitoring, updating, and tracking these numbers. So it's almost good that no one thinks it's perfect, because it is constantly a work in progress.
Even Patricia put a comment or a question, summary or details version.
Yeah, there is on our website, there is a summary and a detailed version of the indirect rate calculator. The summary version, if you've never done your rates before, I would recommend starting with that. You're just going to need your trial balance, and then you're going to have to, it's going to require that you assign your costs to those pools, the 5 pools we went over. Now, if you don't have your chart of accounts pooled, that's okay. You can still use the tool. You just need to take that extra step to kind of pool your costs, whether you just take the balances and move them into a pool, or you look at like travel and make those decisions. Hey, this is 50% direct, 50% G&A. But once you've established your existing cost into the 5 pools, the summary rate calculator will take off. Keep in mind, if you're in a manufacturing, that we can make small adjustments to the bases, like the material and the labor. And like I said, if you already have rate calculations that you're working with and you just want to verify their compliance, then I would encourage those folks to pull the detailed version. I am open up for questions. I believe that our next section, we tried to get started right at 11:30. So I would suggest grab a drink, take a break for just a few minutes here. And as soon as we get switched over to Robert here, we can move right into our next section. And if anyone has questions at this time, I can answer. You can raise your hand, type them in, whatever you prefer now that we're in between sections.
No questions in the chat so far, Stephen.
Yeah, and I've got it on a second monitor as well. I do have, and feel free to ask your questions at any point, to type them in there. But this is our heading for the next one. The next topic, which I'm not going to start immediately, is understanding costs in your proposal.
So a few minute
And
break
just
here.
double checking on my time here. So let's go ahead and let everybody have a break. I don't want them to miss anything. And let's plan on maybe just about 5 minutes and we'll resume.
Thank you.
Hey, Steve, can you hear me? Or if you're talking, Steve, I can't, you're muted.
I can hear you, Robert.
I
Okay.
can hear you, Robert. And I wanted to just confirm with you, do you want me to stop my screen share and allow you to take over?
Yep, I've got it just pulled up on my let me hold on, let me turn off something. I somehow turned on, there we go, maybe that's the right one. I turned on subtitles by accident playing around one day.
And they may have already, but I think they'll have to make you a host so that you can use the sharing function.
Yeah, I did. Yeah, you should be able to, Robert.
And I'll let you know, Robert, your first slide is number, which you can probably see very clearly, is number.
Yeah, I think I'm ready.
All right, so they're on a short break, but I will
okay,
just let you take, or Deanna may introduce you as well.
Hi, Robert.
Hey, how are you?
Good. How are you doing?
I'm doing well, thanks.
Good, good. We'll just get going in a couple minutes here.
Okay.
Should we start? Is everyone ready to go?
I'm ready.
That's the most important thing. Well, thank you, Robert, for plugging in today and providing this information to our companies here in Montana. The Robert Jones is the president of Left Brain Professionals, and he is an expert in government contracts. He knows contracts and how to account for these government contracts, and most importantly, how to profit from government contracts. But he's got over 18 years of Department of Defense contract and accounting experience, and he helps companies successfully navigate all the complexities with the legal and the regulatory framework of government contracting. So very happy that you were able to join us today, Robert, and looking forward to the information. And I'll let you take it away from here.
All right. Well, thank you. Good morning to everybody for joining us. As you've seen, Steve and I are going to be swapping out. I've got a session. I'm going to do this next section, then back to Steve, and then back to me near the end of today's time, and I'll finalize everything for us. So this section is understanding costs in your proposal. And we're going to be talking some of the stuff that Steve went over with indirect rates this morning will kind of begin to flow into this as we talk about cost types and how to evaluate. And I apologize. There it goes. I was having some technical difficulty. There we go. Some of the Steve's information this morning will flow into what we're going to talk about now. So our learning objectives for this section, the first one is list the 5 direct cost elements, describe the difference between actual and standard costs, explain the importance of updating indirect rate budgets, and identify the need for a new indirect rate strategy. So really quick poll question to get started with this section. And our question here is, how many cost and price proposals do you prepare per year? And so there's no right or wrong answer, but we're just trying to gauge some of the people in the audience here. So I'm seeing we've got almost half of the people participating, and the biggest portion so far are somewhere between 0 and 5, between A and B, for those of you who have participated. Again, no right or wrong answer. We'll give you a few more seconds. I do want to get into the content here. So if you want to go ahead and end that poll, that'd be great. Again, we've got looks like about 69% of the people, again, a significant majority, 0 to 5, which means what I interpret from that is that it's we've got some people who may not have as much experience, and that's okay. All right. Sorry, the poll won't disappear on my screen. All right, the direct cost elements that we're going to talk about. What we're going to be talking about here, labor, and primarily we're talking about your W-2 labor and temporary labor, and they do need to be segregated. As you probably recall from what Steve was talking about this morning when it comes to calculating indirect rates, particularly fringe. We do need to know the W-2 labor, which are your employees, separate from any temporary labor that you might get from Robert Half or Kelly Services or something like that, and separated from your subcontract labor, which we'll talk about in a moment. Your labor will be supported by payroll records, offer letters, or salary surveys. And when I say here about it, supported, it means that at some point you're going to submit a proposal, if you haven't already, that's going to go through some kind of, I would say audit. It could go into a full audit. Certainly it could be at least some negotiations, some fact finding. You know, the customer on the other side is eventually going to ask questions. Certainly the larger your proposal, the more complex your proposal, then they're going to be asking questions. They're going to be asking you to validate how you came up with the hours and rates and other information in there. So here again, talking about labor, having payroll records, offer letters, or salary surveys. Material is the second direct cost element. Here, this could be material that's used in the manufacturing process, or could be what we refer to as pass-through materials, where you're purchasing that material on behalf of your customer, whether it's the prime or directly with the government. These should be supported either by standard costs, which we're going to talk about a little bit later, or quotes. And the goal here is that what we tell people is you should have quotes for 80% of the cost of the materials that are going into your stuff. Now, you know, if you have a bunch of large dollar materials, it might be more than 80%. But typically, for example, when we look at manufacturing types of things, usually when we talk about 80% of the materials, or from a cost perspective, we're getting all of the high dollar stuff in there. And then the things like nuts, bolts, screws, caps, labels, that type of stuff that's low dollar, you know, kind of fall out of that analysis, and it's usually not of concern. Our third cost element is travel. And the main thing you want to look at here is making sure that your cost estimates are within the and your actual charges and billings back to the government are within the GSA per diem for lodging, meals, and incidentals. Now, there are no per diem amounts for airfare, rental cars, and fuels. And, you know, the best that we can do is estimate those, because those do fluctuate over time. As most of you know, if you go in today and look for a flight between San Diego and Chicago, which is a normal route for me, it might be $600 today, might be $800 tomorrow, might be $500 the day after. And part of that is, you know, obviously depends on the days of the week that you're traveling, the time of day that you're traveling. And then I can look, you know, for a specific time frame. And even when I go back, you know, a week from now or a month from now, the price for that same flight on those same days could vary. So the best that we can do is put together some estimates and be able to have some screenshots to support how we came up with those numbers. Make sure that in your proposal that you do identify the number of trips, the number of travelers, and the days involved. So that's an area where we've sometimes seen people get the calculations messed up a little bit, is they'll have the trip involved and they'll look at airfare and some other stuff, but they'll forget to calculate, oh, I actually have 2 people traveling and they're going to be there for 4 nights or something like that. So we have to make sure that we multiply all that all the way through so that we come up with the most accurate cost. ODCs, or other direct costs, these are typically incidental in nature, minor costs. They could be for things like miscellaneous supplies, installation items, small hand tools. One of the examples that I use for this You might have, maybe you're executing the work and you're going to have some blueprints printed, right? And many companies don't have a big printer, so you got to go to FedEx or somewhere where they have a large plotter that you can have blueprints printed. So you might have some expenses like that that become a direct cost element. You might be installing a piece of equipment, at a customer's facility, and that there's always, you're going to need, a little shim. You're going to need something, in order to get it to work just right, to be level, whatever the case might be. And so you might keep some of those types of things with you, but when you get there and you start measuring, you realize, hey, we need something a little bit different in order to make it fit in this space. Things like that. So again, as you can see, small dollar, incidental in nature. These could be supported by quotes if if you have a sense of what those things might be, or certainly estimates that are based on historical experience. Our fifth cost element are subcontractors. Keep in mind that your subcontractor proposal to you may include labor, material, travel, ODC, and their own subcontractors, right? So depending on where you are in the supply chain, right, there may be additional subcontractors beneath them. What's important to note here is that we're not going to take those individual cost elements from our subcontractor's proposal. We are not going to code or lump those into our internal cost element buckets. So what I just talked about here is we have labor, material, travel, ODCs, and subcontractors. And within the subcontractors, I actually have the same 5 cost elements now within that cost element, right? So for your purposes, for putting together the proposal, for recording costs when they actually incur and all of that, we're not going to break down the subcontractor stuff and then put them into our buckets, right? Because that could be confusing. If I go back to labor, for example, if you were to take your subcontractor's labor and code it to your internal direct labor account, well, that would cause all kinds of problems in calculating fringe costs, because now that account would have your W-2 labor as well as your subcontractor's labor in there. And those are not really the same thing. Yes, they're both labor, but they are very different types and elements of labor, and we do have to keep them segregated. Now, what you might decide is to say, well, within my subcontractors, I'm going to create, buckets underneath so that I've got labor, material, travel, ODC, subcontractors. And then under my subcontractors, maybe I create buckets for reporting purposes because I want to see all labor across all subcontractors or something like that. That would be okay, again, to break it out within. We just don't want to move it up into the other cost elements. Your subcontractors obviously should be supported by quotes, including a written price analysis and source justification when required. So that's going to be when when certified cost or pricing data is required and the subcontractor proposal is in excess of the truthful cost or pricing data threshold, which is currently $2 million, or if it exceeds 10% of your proposal. And it's that or that gets people caught up and they miss that. So if you have a proposal that you're putting together that's $5 million, and you got a proposal from one of your subcontractors included in that, it's $1 million, you might say, well, $1 million is less than $2 million. I don't have to do the written price analysis and include that in my proposal. Yes, you do, because $1 million is more than 10% of your $5 million proposal that you're putting together. So I hope that makes sense. Again, that's one that we sometimes see people get caught up on. All right, another quick polling question here, please. And this one says, which of the following is not a primary cost element? So think about the things that we just talked about. There is a correct answer here. So which one of these is not one of the primary cost elements that we just talked about? All right, we've got about half the people, and I would say almost all of you have it correct. So if we want to go ahead and close that out, we can. And so the correct answer here is A, alpha. Contingencies are not one of the cost elements. Remember, we talked about labor, material, travel, ODCs, and subcontractors. Contingency in and of itself is not a cost element. And I did see a question here. I will try to answer some of these as we go along. It says, does employee pay for travel in the travel cost? No, that's a labor cost. So labor is labor, regardless of whether it's labor doing the work or labor travel. That is labor. Travel costs are the actual airfare, lodging, rental cars, stuff like that. All right, let's talk a little bit about actual versus standard cost. And specifically, I'm going to start with standard cost. So standard cost is something that we typically find in manufacturing, though it could be used in services. That requires the development and the maintenance of standards, meaning that, you know, I've got to do time studies, I've got to do analysis of costs. So for example, if I have a part, if I'm manufacturing and I have a part and I want to determine the standard cost of that part, I need to know the amount of labor, the people who, or the labor categories who are going to do that work, what the price is, you know, what is my cost for those labor categories. I need to know my overhead rates to apply to it. I need to know the material costs. And then, you know, I look at it and I say, okay, well, and then I have to do like time standards and stuff for that part. How long does it take me to perform each step on the router? And I calculate all this data through and I come up with a standard cost. And my standard cost said, if everything is right, if it's the correct labor categories and they take the appropriate amount of time to do the work, it should cost me this, right? So think of standard cost as kind of a should cost me this if everything goes correctly. But it means I've got to do work to develop those standards. Because you are developing a standard, is essentially an estimate. It is subject to extra scrutiny by auditors. And I will tell you that as we go through price analysis or proposal audits with our clients, if they're doing manufacturing and they've got standard costs, without a doubt, we always get a lot of scrutiny from the auditors going through, because they want to make sure, like, when was the last time, you know, you updated the standard? When was the last time you evaluated the time standards with it? So there's a lot of things that come into play. If you're doing standard costs, they do need to be updated. Working with a client on an audit right now that have not updated their standard costs in about 3 years. And so getting a lot of questions and pushbacks from the auditors on that. But they do need to be updated at least annually. And primarily the reason for at least annually is you've given pay raises throughout the year. So now your cost of labor in there is higher. Your overhead rate should have changed, even if it's just a minor amount. Your actual overhead rate is going to change over time, so that needs to be updated in there. And you should be looking at material costs, right? Material costs over time will increase, and at least annually, we should be getting updated quotes from our suppliers for these materials so that we can flow that into our standard cost calculation. You also need to do updates if there's a change in the process or the manufacturing engineering, meaning that we've evaluated the way we assemble or manufacture this product and realize we can do it better, faster, or whatever the case might be. Well, those types of things are going to affect standard cost, right? Because I might be reducing time. I might be adding material to the process or something. I might be actually adding time. Maybe we've had problems with the part and we say, hey, we're going to insert another inspection step. Well, that means somebody else is coming involved, right? And now got to account for their time in the process. So any kinds of changes in there, change the bill of material or the drawing, right? Meaning that, hey, we've moved something around, we've swapped out a part, that part number has changed. Again, any of those types of things that affect the part ultimately are going to roll up and affect the standard cost. And then another one to consider is a change in lot size or annual production volume, right? Part of our time standard as well as part of our material cost are based on quantity, right? We're gonna make these in batches of 100, and we think we're gonna make 10,000 of them this year. So when we get pricing from our suppliers, right, that's the pricing that we get. Hey, we're gonna buy 100 of these at a time. or we might actually buy 1,000 of them at a time. We're going to manufacture them 100 at a time. And if you run 100 of something through your production line, you're going to be more efficient with those than if you're only running 10 through at a time or 5 through at a time. So we have to make sure that if we're going to change lot sizes, we go back and evaluate the impact on the standard cost. Again, as well as overall annual productions that could affect our material costs coming in. I mentioned a little bit already, but just a reminder, we need to do regular time studies or analysis of actual time recorded against those products that where we have standard cost. Because again, the standard cost is based upon, hey, it should take us this amount of time. Is it doing that, right? So we need to either have people clocking in and out of shop orders or some way to track that, or we do good old-fashioned time studies where somebody goes out with the time, with time clock, with the stopwatch and says, okay, they're watching them and calculating the time that it's taking them to perform those steps. We have to do a reconciliation of purchase price variance or updated prices from our suppliers. Again, prices change over time, certainly a lot over the last couple of years, and continue to change with the pandemic, supply chain issues, inflation, right? There's a lot going on that affects prices of products and raw materials that we purchase. And invariably, we're going to have purchase price variance. Those variants are one of the things that auditors look at and ask questions about when it comes to, again, an audit, fact finding, some type of price analysis. They want to know, hey, have you evaluated this and the effect of those variances on the overall cost? And I already said any other annual or indirect rate updates. So in comparison to standard costs, let's talk about actual costs. The nice thing about actual costs is there's no need to develop or maintain standards, right? I'm going to record actually what happened, when it happened. I don't have to do these time studies up front. I don't have to try to figure out what all's involved. I don't have to build that. I don't have to maintain it. I don't have to update it. I don't have variances to sort through and reconcile because I'm recording actual cost. And the nice thing is that your accounting software will handle this. And in fact, what you'll find is that many vendors and consultants, if you look to make a change in your accounting software, will say, hey, you really should consider actual cost. It's easier, it's more accurate. We don't have the variances there. We don't have to deal with some of the hassles of building and maintaining that standard cost system. And the other thing is that you know exactly how the contract is performing, because any variance to the cost will actually be built into the product, to that project through actual cost. Whereas in a standard cost environment, we take those variances and they get put into overhead, meaning that we end up spreading those variances across multiple projects or across multiple product lines, depending on how your overhead is structured. And so we lose visibility. We might be able to see, hey, there was, we had X, Y dollars of purchase price variances or labor variances or whatever in a period, whether that's a month or a year or however you calculate it. But when we start plugging that stuff into overhead, we really lose the visibility of what the driver and the reason for that was. If we do actual costs and we charge everything to the project when it comes in, then I can see on a project by project basis, I can compare that to the project's budget or the estimate that we prepared and know how did we perform in comparison to how we thought we would perform. All right, another polling question here, please. And I think you guys will see we've inserted number of these today, really just to get some interaction, make sure people are paying attention. So this one says the costs are commonly subject to additional scrutiny by auditors. And your choices are true or false. So let's see how many people were paying attention. Standard costs are commonly subject to additional scrutiny by auditors, true or false? And I will say that most of you are getting this correct. And yeah, if we want to go ahead and close this out and share the results, the correct answer is true. Remember that I said that if you will see if you have standard costs and you include that in a proposal and you go through some type of audit or fact finding, The auditors are definitely going to hone in on that. They want you to be able to support the standards that you are proposing. Let's talk now about updating indirect rates. And again, just a quick reminder on this section that I'm talking about here, this whole section is about understanding the costs that are in your proposal. So you got indirect rates. What we just got done talking about was really all of the direct costs, right? We talked about labor, material, travel, ODCs, whether they might be standard or actual. But then we have to apply our indirect rates on top of that. That's how we get to the total price. We got all of our direct costs. We have our applied fringe, applied overhead, applied G&A. Then we, whatever our fee or profit is that we're proposing, and that's going to get us to the total price at the bottom. So this little subsection here, we're talking about updating indirect rates. And this is an interesting concept that some people struggle with here. We need to update the indirect rates for each major proposal. So what's a major proposal? This is my definition of a major proposal. This is not a regulatory definition anywhere. But I say anything that increases your revenue, your annual revenue by more than 20%. Most companies can usually absorb a fair amount of new work without, a significant increase in other costs. But typically, if you have, 20% or more increase in revenue, you're probably going to have to hire more people. You might have to rent another facility or lease vehicles or whatever the case might be. You might have to buy new equipment, right, to be able to support that work. And so that's why we say a major proposal, we're going to go back and reevaluate, really recalculate our indirect rates. And notice that I also said that this is for each major proposal. So let me give you a quick timeline of what this would look like. We recommend that people prepare their budgets in the August and September timeframe. And in fact, the next section, Steve's going to come back on and talk to you guys a little bit about budgets and working through that. So we recommend that you build your budgets in the August to September timeframe. You're going to put that together with some of the stuff that Steve's going to talk about. And it's forward looking, right? So in August, September of 2021, hopefully put together a 2022 budget. And now here we are, April 21st of 2022. You've got a big RFP that just landed in front of you. You say, yes, it would qualify as a major proposal for us. And I say, you need to update. You're not changing your budget. You're not changing your budgeted rates. You're not changing your provisional billing rates. We're not talking about that right now. We're saying that for this proposal that you're putting together, you need to calculate and evaluate a new set of indirect rates, because winning that's work, when you combine it with what you've already have going on, is going to affect your indirect rates. So you're essentially going to create, you've got your, what I would call your Rev Dash or your Rev Zero budget from last year. And now you're going to create a Rev One that's only going to apply to this proposal. And then again, next month, if you get another RFP and a major proposal, and you say, hey, this qualifies as a major proposal, you're going to have a Rev 2 version of your indirect rates that you use only for that proposal. Again, I'm not going to update provisional billing rates or anything else right now. You're just saying that if I win this contract based upon what's already happening this year in my prior budget, how would my budget change? So that's what you need to be thinking about here. When you do these updates, it should reflect any year-to-date actuals, plus any contracts that you won or lost. So perfect example, it's April 21st. Hopefully everybody has all of their books closed through the end of March. So I've got good information for 3 months of the year of my actual experience. And my budget, when I put it together last year, part of me putting together the budget was I had some assumptions on some contracts that I thought I would win. Well, now that it's April 21st, I might realize I've won a contract. Maybe I didn't win a contract. Maybe a contract pushed out to the right. Maybe another proposal actually came up and I won it, and it wasn't even in my budget from last year, right? So I've got to take those types of things into consideration. So I'm taking the snapshot, when I'm doing this update, I'm taking a snapshot of where I am now with what I know, as well as this proposal and what it would do to my business. So I'm just creating a snapshot looking right here today at this specific set of information. And again, remember, that winning this contract would have a significant impact on your rates. And the ultimate goal in all of this, hopefully you guys come back, we get on to some of our other webinars that we do. We talk a lot about indirect rates, pricing, and proposals. But the goal is ultimately to avoid any significant under or overbilling to the government. That's, because if you don't update these indirect rates, so let's say you just put together your budgeted rates from last year, you charge forward, you keep those on all your proposals, and you get a proposal that maybe is 30, 40, 50% increase in your revenue. You didn't change your rates, you just charge forward. Well, the problem is when you get to the end of the year and we calculate your actual indirect rates, and this is really important when we're talking primarily about cost type contracts, but it has an effect on how we price out any type of contract that we do. But you don't want to get to the end of the year and then realize you've significantly underbilled or significantly overbilled the government. Because if you've underbilled the government, then you run the risk that maybe there's no additional funds available on the program for them to give it to you. So even though you have a legitimate claim, the government doesn't have any money associated with that program to be able to give you the money. Or if you've overbilled the government, then the contracting officer is going to be standing there with their hand out saying, hey, we paid you whatever. We paid you $100,000 more than your actual cost last year. You need to give me that money back, and I want my money back now, right? And situations like that can be very difficult for small businesses to write those kinds of checks. So what's a sign, and this is where the reason I put this in here is that one of the calls that we get on a regular basis is oftentimes when people are working on a big proposal, they're saying, hey, we've been thinking that maybe we need a different indirect rate structure. And when we're sitting here working on this big proposal, it's $5 million, it's $10 million, whatever it might be. And they say, man, we think we need to price this differently. So what are some signs that I might need a new indirect rate structure? So the first is if you have multiple product or service lines. We've got a client right now that has some big diversity in the services that they provide. And we're actually in the process of putting together, we've modeled it out. We're down to hopefully finalizing a few pieces of it. They're actually going to 7 overheads, plus an intermediate facilities pool, plus a material and subcontract handling pool. And it's a very complex layout, without a doubt. But they have that much diversity in for them it's services, but they have that much diversity in their product or service lines that they need that many indirect rates so that they can accurately price the services based upon the cost that it takes to deliver those services. If you have multiple operating divisions or locations, again, think manufacturing versus engineering, think having maybe offices in Florida and Virginia and California and somewhere else, right? So if you've got any kind of complexity, that's another way to think about it. If you see the complexity in your organization, those are signs of needing a new indirect rate strategy. If you're doing both SCA, so SCA or Service Contract Act, if you have SCA and non-SCA contracts, again, another indicator. If you do a significant amount of client site work, meaning that your employees are actually at your client site, whether that's the government or the prime. Typically what happens here is that the customer says, hey, why are we paying your overhead for your employees when they're sitting in our facility using our equipment? We're paying the heat, we're paying for snow removal, all of that type of stuff. They want to see a different indirect rate structure to support that. And then the other, and there could be some other ones, but probably the last one here is if you have significant pass-through materials or subcontracts. So oftentimes the government will develop relationships, with a contractor, and over time say, hey, you could procure more of the materials for this program or this project for us. We'll just funnel that through you, because it's easier for you to do that and us to just pay you to do it. And so oftentimes what will happen is you do more and more of that, and usually you would tack on your G&A rate, and then at some point your customer says, hey, your G&A rate's kind of high to be adding on to all these materials. what can we do? And the solution to that really is to set up a material and subcontract handling pool. Easy for me to say some of this stuff on here. Implementing it is certainly not, I mean, it's all possible, and we've implemented all of these kinds of things, but it does add a layer of complexity to your accounting system and your process. The other sign, and this is really, again, probably one of the first ones, but if you're noticing a loss of competitiveness or profitability, that's honestly one of the common phone calls that we get. And when we get those, that's a trigger to me that 9 times out of 10, there's something wrong with the indirect rate structure. So we have people call and say, hey, we're bidding this work, but we're not really winning. And we're, we're getting feedback that, we're not the most competitive, or they say, hey, we're doing this work and we're executing it and we're getting paid, but there's just not much money left at the end of the month. Both those usually have something to do with indirect rates and not properly pricing the products or services that you have. I do want to say that ProPricer, and we should have deleted out this particular slide. But ProPricer is a great tool that's out there. And they can help you display multiple what-if scenarios when you're putting together a proposal. If you're curious about that, contact us separately. Happy to point you to them and to a demonstration webinar that they have. So what are some issues that we see when it comes to proposals and pricing kind of stuff? One is more often than not, I hear about people backing into a total price. And this happens a couple of reasons. We see it a lot, particularly in the SBIR and the STTR world, because people know what the dollar value is. Sometimes people have good relationships with their customers. They say, hey, we've got whatever. We know we've got $500,000 for this part of the project or to do this thing. And so magically what happens, right? Somebody puts together a proposal and it's $499,982.72, right? Because it's got to be under the 500,000. And then what we find is that they backed into the number. They didn't really do a good cost roll up and understand what their cost was to provide it. Now, don't want to get too far off course here. I mean, you can roll up your cost and ultimately decide that you want to negotiate a different price with your customer, and that's fine. But oftentimes, again, what we see is that people kind of back into a number without really understanding the cost, and that's where they get themselves trouble. We hear people guessing at indirect rates, or somebody told them to use a rate. Maybe they're using old indirect rates. They haven't updated their indirect rates, maybe. I mean, sometimes we hear people say, oh, we haven't updated our indirect rates in 3 years or 5 years. And I'm like, well, how are you proposing? Because obviously a lot has changed and happened in 3 years or 5 years. We sometimes hear somebody say, oh, well, Joe came to work for us and he was helping us put together this proposal. And he said fringe was 28% at his last employer. So we just plugged 28% in for fringe. Again, that's somebody else's number. That's not your number. You need to calculate and know what your indirect rates are, the stuff that Steve was talking about, because those are the numbers that are going to flow into your proposal and pricing. Another one that gets a lot of people in trouble is having an incomplete or a non-existent basis of estimate. Some of this is oftentimes tied into that backing into a total price, or just not having good notes, not having a good system to roll up and say, okay, here's the list of tasks that are required in this project. Here are the labor categories involved. Here's the number of hours. Here's why that, and this is the key part for a basis of estimate. Why is that labor category performing the task? How did you determine that that task was 100 hours versus 75 hours versus something else? Those are the kinds of questions that you will encounter if you haven't already been through that. Those are the kinds of questions that you'll encounter when you go through, again, fact finding or audit. They want to know, they don't want to just see, oh, well, this is what you put down and they're going to verify the math. Certainly they're going to verify the math, but they're going to say, hey, wait a minute. How do you know this is the right labor category? How do you know this is the right material or the right subcontractor or the right number of hours? Those are the questions that you need to be able to answer. And the answers to those questions come from having a complete basis of estimate. All right, so another polling question here. I do see some chat questions. I'm going to skim those while you guys are answering this poll question. So the poll question is, how confident are you with the costs in your proposals? So we've only had a couple of people participating, and we've got a poll question up here. How confident are you with the costs in your proposals? No right or wrong answer here, and we're split about 50-50 on the few of you who have answered. All right, so if we want to go ahead and close out this poll. So it's nice to see that about 50% of you say you're confident enough. That's good, but we obviously see some of you are saying, hey, we need some amount of help. So please don't hesitate to contact us. If you don't already have our contact info, it'll certainly be available. We'll have it up on the near the end of the presentation on a slide, but you can always email us support@leftbrainpro.com. And I will put that in the chat for everybody. So again, it's support@leftbrainpro.com. I do want to look, I saw Steve answered a couple of questions, but I do want to circle back on some of this. Somebody said, what are the common mistakes that you see in accounting systems, and what steps can businesses take today to correct those errors and begin tracking costs to maximize profitability? As Steve said, not having good separation and identifiable indirect cost pools. Yeah, we oftentimes, because in the commercial world, people will say, I've got my direct costs or COGS, cost of goods sold. So direct costs are just really another word or another phrase for COGS, cost of goods sold. And in the commercial world, and then it's like everything else is overhead. Right, so we hear people say, I've got COGS and I've got overhead, and it's this big lump sum pool. Well, in government contracting, and in reality, in commercial contracting, you should be doing the same thing. But in government contracting, we take that all other overhead and we break it down into fringe, overhead, and G&A. And in fact, for those complex organizations that have multiple product lines or multiple operating locations, maybe they're doing SCA work, maybe they have some employees at a client site, whatever that complexity is, and sometimes it's some mixture of those things. We take and we further break down that big overhead so that we really understand the costs for each of those. So let me just focus on the single fringe, single overhead, single G&A. If I've got this one big all other overhead pool, I can calculate a single overhead rate and I can watch it go up and down from month to month and year to year. Problem is, because I have so many different types of costs going into that single overhead pool, I don't really know why, without a lot of work, why it's going up, what's causing it to go up or down, or how can I manage it from going up and going down. When we break it into fringe, overhead, and G&A, I now have grouped my costs and my cost drivers together, and I have a relationship. So for example, when I look at fringe, I know that the pool of fringe are my cost to maintain my W-2 employees, and the base or my denominator of fringe is my W-2 labor. And so if my fringe rate goes up or goes down, I know. So for example, if my fringe rate goes up, then I know one of two things happen. Either the pool went up, meaning that my cost to maintain W-2 employees went up, or my W-2 labor went down, meaning that maybe it cost me the same amount of stuff for retirement and health insurance and some other stuff, but the actual cost of my labor went down. So when I break these out, I now have a little more refinement in being able to understand those types of things. That refinement then allows me, I can immediately go, oh, this is where I was last month, last year. And when I understand what's in fringe or what's in overhead or what's in G&A, when I see those fluctuations in the rate, it's easier now to hone in and say, oh, now I know what's going on. And again, take then the concept of saying, well, instead of having a single overhead, if maybe I've got 2-3 overheads because If I break that out into 2 or 3 overheads, again, now I'm getting even more finite information. I'm seeing, well, this overhead is going up or down in comparison to this one or comparison to this one. All right. I had another thought to finish that out and it just slipped my brain. So maybe it'll come back. Let me go back and read the question again. Maximizing, it's again, I think from a maximizing profitability perspective, probably the number one thing is that we come across clients, they just don't understand their indirect rates. They haven't calculated them. They're not properly structured or calculated. And they just don't understand all of what goes into building their stuff. And so if you're what I was, and I somewhat jokingly when I say this, but we don't have clients calling to say, hey, I've got way too much money and I can't get to the bank fast enough, right? They're not calling us saying, hey, the profit is just overflowing and I don't know what to do. They're calling because they're saying, hey, we're not winning the awards that we're proposing. We're not, or we're winning work, but it's not as profitable. There's not as much money left over and we don't know what's going on. Those are the types of things that that really dig into that profitability. So when we work with clients and we help them properly calculate their indirect rates and then build that into their pricing structure, now they are pricing in a model that allows them to achieve total cost recovery. And now those costs, we're minimizing or eliminating some of those cost overruns or cost errors. And those cost overruns and cost errors are otherwise eating into your profit margin, right? So if you understand all of your costs and you roll that up properly, now you've got total cost recovery, add your profit or fee on top of that. Now you're much more likely to hit those profit and fee targets because of that. And I apologize, I see some other stuff going on here. Oh, somebody said, so I see we've got, it's so interesting here, people participating. We've got somebody leasing office space, defense, medical stuff, machine, aerial imaging, fire mapping. So we've got a variety of people in here. This is really good. Before I sign out, because I have to jump, going back to another meeting. Any questions before I turn it over to Steve here in a couple of moments? Any questions on what we've talked about?
Excellent information, Robert. Thank you so much.
Yeah, thank you.
I suspect people will have questions as we go here, so
Sure.
circle back in a bit.
All right. So again, I'm going to drop out. I'll be back in here in just about an hour or so.
Great, wonderful.
All right. Thank you, everybody.
Thanks, Robert. We
Thanks,
are
Robert.
a little bit early here. Should we take the break now, the longer break? Stephen, is that how you want to do it?
Yeah, I think we've got 15 or 20 minutes. That this is the basically the halfway point here. So I think if we do take a little longer break now, then we can go straight, not straight through, but move through the last two sections.
Okay.
The budgets, which I'm going to start after the break, is a little bit longer than the strategic pricing, and we will try to allow just a little bit of extra time at the end, because Robert and I will both be there at the very end.
Okay.
A little couple extra minutes for questions. So if we go ahead and do a 15-minute break now, I will be ready to go at say 12:35 or 10:35.
Yep.
Depending where you are in the country.
Yep. That sounds great.
I'm sorry, I just have one thing. Somebody signed in with their phone and it ends in 9088. So if that person can type their name in the chat, we take attendance and want to make sure everyone gets the slides and the video when this is done. So
Thanks, Bob.
thank you.
All right, we'll see you back at 10:35 our time here. Thanks.
All right, thank you. I'm all set, Deanna, whenever. If
Yeah.
there's no
that
rush
sounds
at
great.
all, but whenever you're ready.
Yeah, I think we're close enough here. Take it away. Thanks, Stephen.
Okay, well, hopefully everyone was able to take a little breather and get back. We're more than halfway done here. I will real quick just mention the more questions and audience engagement that we have to make this as productive for you guys as possible. I want to just not necessarily right this minute, but open up the questions, especially when Robert joins us again for the fourth section. Any accounting contract related, just to encourage engagement. If there's something that you're wondering or you have a specific scenario, even hopefully it's accounting government contract related, but if it's not included in our topics, don't hesitate to pick our brains and ask those questions as well. I'm going to try to allow just a few extra minutes after the fourth section for questions related to the content or of that nature. So our third topic today, and hopefully the first two kind of tied, the basics of the indirect rates to their benefits and use in those proposal costs. And as much as Robert mentioned budgets and updating these items, that should all flow very nicely into this third section. So budgets, indirect rates, and proposals as they all relate. We have 4 learning objectives. List 3 kinds of budgets. Describe 3 steps for preparing budgets. Third one, explain how budgets are related to indirect rates. And then identify when to update indirect rates as a part of the proposal process. So some of this obviously is going to be very similar to what Robert and I went over, but we're going to start out with a poll just to get a feel for where you guys are at. Do you create budgets in your own organization? I'll give you a few minutes to reply to that, and we'll dig right into the content. So we do have a array of responses, and we can probably go ahead and end the poll and share the results here. 40% of you are always doing a budget. That is great to hear. Hopefully that's being completed, at appropriate time before the year starts, and updated and analyzed throughout as time goes by. So moving along here. The 3 kinds of budgets that we are going to identify are enterprise budgets, project budgets, and proposal budgets. Going into the detail here, the enterprise budgets are a corporate budget for the entire organization. This is including all expenses, direct and indirect. This is probably what you would think of when someone just says, I have a budget, that it would be for the entire organization. Just a little side point. Speaking of the organization, there is always one fringe rate if you have one fringe pool. Sometimes folks will want to try and calculate, the fringe for this contract, the fringe on our commercial work, the fringe, but within compliance and the required standards, there should be one fringe rate, one G&A rate, and then depending on your pool structure, overhead can have a little bit of fluctuation. So some of the issues that we see in our specific work with government contractors that, like I mentioned, they've got budgets related to specific customers, specific projects, maybe departments. They want that enterprise level. Late budgets, if it's already April, it's really easy to make your first quarter budget, which isn't going to be very beneficial because the first quarter ended 20 days ago. Reusing last year's numbers, we will get into this more as we talk about the top down and bottom up budgeting approaches. Bottom up is obviously the history, which we recommend a hybrid approach where, you do look at the history, but based on those major changes that Robert mentioned being 20% or larger, especially in revenue or direct costs, is going to really change your budget. And that is the time when that historical data it's just not going to benefit you. The second kind of budget is the project budget. Now this is kind of specific to our bid and proposal topic, where the project budget would focus on your direct costs or those costs directly related to that final cost objective. Now that can be useful in the RFP process, the proposals and bids, and even the indirect rate calculations. Some of the issues we find in project budgets that they are not time phased. And what we mean by that is they don't allow for like option year one, option year. Sometimes the prices can increase. So that's one aspect. No consideration for overtime. This is a very sad example. We had a client that had they had existing contracts, and in the scenario that their industry, they had a lot of overtime, overtime and double time. And they did not account for that in their overhead rate. And you cannot, in the direct costs or cost of sales, they agree to, like, if your contract has labor categories and they specifically say, we're not going to pay more than $80 an hour for this labor category, and you bill that person at that $80, that's all fine and dandy. But when they're earning time and a half or double time, if you don't have that overtime premium identified and part of your overhead or one of your indirect pools, that's potentially a major risk for overall loss. So overtime is kind of a big one if that is applicable to your staff and your direct employees. And then missing direct costs, Robert kind of touched on that, where you might know what the flights are for that city and the per diems, but you don't account for 3 people are going. There you've got to, maybe that's not material, but maybe it is if the errors like that do occur. So the project budgets, and the third is the proposal-based budget. And this is a budget similar to a project, but this proposal-based would include direct and indirect expenses, like an enterprise budget. And then the rates can be calculated, because with just direct costs, you cannot do the accurate calculation of those indirect rates. So with the enterprise budget, with a significant proposal, I recommend starting from the top with the potential revenue, then what cost of sales is needed, or what changes more specifically are required to support that new level of revenue. So then you've got revenue and cost of goods, and you get to your your indirect pools. You ask questions like fringe. If this changes our staffing, that translates directly into a fringe increase or decrease. Overhead, same thing with the direct costs more so. What overhead is going to support these budgeted or proposed direct costs. And then G&A generally is not as affected by a revenue or direct cost change because your accountants and, they're not performing direct labor. Hopefully they have a system and policies in place to accommodate the increased volume. But if you're not, buying new software or taking on new staff to accommodate that, your G&A costs may not be affected as much as the other pools. So in some of our findings, which some of this is going to kind of go right back to Robert's section on the costs in your proposal, backing into a total price instead of rolling up. That is, and really once you have your indirect rates calculated accurately and in compliance, you can get what is provided on our template is a wrap rate. It's basically a combination of all of your rates. And it's not just adding them together. That is a common, I don't know if you guys want to go back to your statistics classes. Combining 3 percentages is a little more complicated than just adding them together. But with accurate indirect rates, you can calculate that wrap rate or burden rate, which can help you make sure that your pricing is accomplishing total cost recovery. And then one aspect on our indirect rate tool, once you get to that break-even number based on the wrap rate, we have a spot where you can adjust the fee. And in government contracting, fee is a synonymous term with profit margin. So you can dial it, it'll show you to recover your costs and break even, you can bill at this amount or that amount. And then as you dial that fee to a percentage, usually in government contracting on the lower side, you can see an additional pricing calculation that includes that fee or profit margin. That can be very helpful as you're trying to price your services and goods in a proposal setting, allowing for all of those changes. So missing or insufficient basis of estimate, we got our little industry abbreviation there. That Robert touched on quite a bit as well, that your pricing data, your estimates, the more accurate all that information is, and keeping up with the changes and the inflation, whatever those effects may be, is going to give you a better basis of estimate. Old rates, proposed rates, I've heard so many clients say, our competitor or the contracting officer said they want the rate to be, we want your G&A rate to be less than 20%. Well, that goes back to my point in the first section. The rates are what the rates are. And if your actual G&A rate is higher, double, any amount higher, and you agree to, hey, 19%, because it's going to be less than 20, you risk potentially losing, even on a long-term deal. Once you propose and are awarded, especially in a fixed price scenario, you're taking on that risk that we said we can do this for this amount. In the cost type world, they have the annual reports that calculate over or under billing, but that is certainly using old rates or industry rates. And there is no, you can say, like I said, fringe, we see from 20, 25 to 40 or 50%, and neither rate is wrong. Some companies use the fringe as an incentive in this competitive market. Like the overtime with my previous example. If those staff members are coveted and aren't getting that overtime premium, they may choose to work for an organization or a competitor that does. So using old rates is rarely Unless, and if your contracts are all very specific, and even as time goes by, costs go up. So I think that kind of really goes deep into the old rate pitfalls. Indirect rates not updated for significant proposals. That was a major point in our second section, that they definitely, if you're not allowing for changes in those revenues, direct costs, and putting that into your budget preparation, then that data becomes less and less useful and cannot be relied on. Clients call because they cannot support their costs or rates during an audit. Yes, and that's often, and like going back to the fees, if they have a contract with an 8% fee and they're only earning 2 or 0% profit margin, we'll get the call, did we make an error in our pricing? Is our rate calculation wrong? And when you're not earning the fee that you have established in your contract, usually it's an indirect rate issue that can contribute to that. So got our second poll question. What types of budgets do you use or create? And we've got our 3, enterprise, project, and proposal. And maybe I suppose we should have had an option here for all 3, but we'll give you guys a couple minutes or seconds here to think about that. And then I will share the results shortly. Okay, I think we can go ahead and end the poll, Rosalind. And 40% here are showing proposal budgets, which is good. That's kind of a part of our theme for our workshop today. So if you're writing a lot of proposals, then that's great that you're using those budgets related. Hopefully you've considered all of these important aspects and got the most accurate and current information that is available, and that your accounting system can record your data to give you the capability to calculate those. So 3 steps for the preparation of a budget. And I did touch on this early on. First step is the top-down method, which is revenue focused, identifying your potential future revenues, as well as identifying the direct cost necessary to support that revenue level. And the key word there is necessary. You can take that into consideration when you do have a major change, being 20% or larger. You can be sure that that is going to affect every one of your cost pools, and that your budgets should reflect those suspected differences. The backlog and weighted profitability of outstanding proposals. Those are things definitely to consider. The backlog aspect, if your existing work and staffing is not going to allow for even your estimated utilization, like if you have a major proposal and your employees right now are so busy that you're wishing they would do less overtime, that timing, that workload should be considered in your top-down budget, because that may be a clear sign of the requirement for additional staff, temporary subcontractors, whatever the case may be, to offset that workload. The weighted probability is simply assigning a percentage. If you're doing an annual budget and you're proposing to 10 plus bids a year, you might have a way overstated budget if you assume you're going to win all of those. So the weighted probability idea simply says you put a percentage chance of success. If it's, if you've got a total of a couple $1 million of contracts and you're bidding on a $10+ million contract, the probability of that expansion might be less, like 30-40%. Where if the contract is similar to your existing one, you have a good relationship with the prime or the contracting officer, and it's right in your niche, if you will, the weighted probability on that other proposal may be 80-90%. And you can multiply your revenue estimates by your probabilities and get that annual forecast. And I say forecast instead of budget because at that point you're making educated guesses, but when you're putting probability and likelihood of winning or losing, you are guessing a little bit there. And other work kind of weighs back into my points on the backlog. Will you need more staff? Will your staff be able to handle the additional revenues that you may predict? So step 2 is the bottom up. And this is, there are in your indirect pools, which this primarily the historic or bottom up portion is more helpful for your fixed costs. Like your fringe. If you pay, I think the add of employer portion taxes is like 8.65% when you add FICA, FUTA, and SUTA all together. So if you hire new employees, that is an easy fixed cost that you can calculate in your indirect budget. You know what they're going to earn or what you're going to propose. That 8% of employer taxes, their share of healthcare, therefore the fringe costs in general are somewhat fixed to your quantity of staff. And that's where the bottom up and the historical information can be a little bit more useful with known changes. You may get your medical insurance estimates and they say, hey, it's going to go up 12%. That's obviously a very tangible number that you can add to your budget as you're budgeting for those medical costs in the future. Then you get back to your other indirect pools, your G&A and overhead and the labor. That becomes more static costs that you can't accurately, like the pandemic over the last 2 or 3 years. We may have had a lot of that overhead idle time for our direct employees, or as the emergency contracts come out, maybe it was the other way. Maybe your overhead labor just went away because everyone was doing direct labor, and that would be absolutely great, if you find yourself in that situation. But that in the second step in preparing your budget is to do the top down and then the bottom up. And the third step is merging or marrying those historical figures and forecasted figures together in a hybrid budget. Looking for gaps is simply things that, don't make sense or might have been forgotten, like the travel example we used, that a team is going and you may have accounted for one traveler. Other gaps, there just might be something when you look at your historical data and then your forecast with all the hybrid, something has a large variance from even budget from year to year. That could be a potential gap where maybe there was new costs or anticipated costs, but maybe there was something that wasn't quite right. And then indirect cost investments. This is kind of some more of the larger costs. Like we can talk about the possibility of where your capitalization rate is. And this goes a little beyond the government contracting to just general best practice. The standard capitalization rate for a small business, I believe they put at like 2,500, and I'm not a tax accountant, so don't quote me on that. But what we suggest is that that is usually a reasonable number. If it's any lower, you may find yourself capitalizing things like laptops and computers. And then, they break, they change, they trade, someone gets a new one and someone else takes that one. They may fail just because of technology. So the point of all that, capitalization rates and indirect cost investments, is you may spend all of your time depreciating, tracking, struggling to track things like laptops. And if your capitalization rate is a little bit higher, you can save your accounting staff, or if you're the one guy that wears all the hats, your own time, not trying to have depreciation schedules and dispose of assets and capitalize things that it may not benefit you, to just put it as a period cost and let it hit your indirect pools. So moving right along, the budgets and indirect rates. Now we're going to talk about how your budgets and your indirect rate calculations all work together and are interrelated. So enterprise budgets result in proposal and interim provisional billing rates. Proposal budgets result in indirect rates for that specific proposal. So this goes back to our initial three types. When you're doing organizational or enterprise budget, those are going to be potentially your provisional or billing rates for that entire organization. And then when you get to your proposal budgets, that you add the indirect and direct rates, you're going to have pricing rates specific to that RFP, that potentially major change, or even not a major change, just accurate billing rates based on that project. And the enterprise rates, like we said, for an organization. One really quick example, if you are doing a large percentage of commercial work and a very small percentage of government work, your enterprise budgeted rates could be drastically different than your proposal budgeted rates. So that is definitely something to consider, just the percentage between government and commercial work, because that it doesn't always translate. The profit margins are a little lower. There's the security, and a lot of these contracts may be multiple year awards, allowing you to write very accurate budgets and really have a really good idea of where your business is heading, where with a commercial project could be long-term, but sometimes it's harder to predict and forecast the commercial activity. Continuing on here with the enterprise budget rates, need to be revised and don't change the baseline. Winning or losing a major contract, other budget issues that cannot be resolved internally. So what we're saying here is, when you're doing your organizational budgets, don't be afraid to do those revisions. And then winning or losing a major contract, that can have such a drastic effect that you may want to reanalyze. So we have another room poll here. Do you update indirect rates for significant proposals? And this is another one just to kind of get a feel for some of your individual practices. And I know on this question specifically, I really don't have a right or wrong. because if all of your contract work is very, very much the same, you may not be required and it may not be necessary. I mean, there could be changes with the day and age or the period in the markets and things and pricing. But if you do a lot of diverse or different divisions of government work, those individual proposal rates become very important. So we had a pretty good split, 55-45, with more people saying that they do not need to update their rates for significant proposals. And we recommend taking a look, especially with that word significant. You definitely want to keep in mind the potential change in your existing rates. So now our next slide here, we're talking about updating the rates for a specific proposal. Cannot stress the importance of this topic enough. Winning a significant contract equaling 20% or more of your revenue will have a significant impact on your rates. And that's one note there, define significant. Depending on your size, your percentage of government commercial, it may not take 20% to that be considered significant in your specific organization, or, you know, that may be too low. But that's definitely something to think about. But whenever you consider a significant, whatever you consider significant, it is very important to make sure those things are reflected in your budgets and your rates. Okay, so the direct costs, this is just some more general tips here. The direct costs drive all the other rates. If we think back to the actual math that we displayed in the indirect rate calculation, your direct costs, whether it be your labor, the allocated fringe and overhead on the direct labor drives. So ideally, you want to kind of maximize, you know, your direct, because direct labor, although it is not 100% true, most direct labor is billable back to the customer. And I really want to stress that is not 100% of the time. There is certainly direct labor that is performed for a final cost objective that you need to record as direct, but may not necessarily be billable. Just a real quick example of that, it would be travel. Some contracts will specifically say, you're only going to bill us for the hours that you're on site. We had a client that did surveying out west, and oftentimes they were an environmental organization, and they would find themselves traveling to remote locations. And that travel time, their direct employees would not be traveling to these locations if not for this contract. So that travel is direct labor, the time they spend, but in turn, because of their specific contract, and they do surveying and environmental stuff, it's almost a standard in that industry that you only are billed for the time on site. So, that is our first point here, and then propose with what if rates. And then once it's officially won or lost, to adjust the enterprise budget and other interim provisional billing rates as necessary, pardon me. And this goes back to our previous couple of slides. When you do the proposal budget and get the rate calculations specific to that proposal, you don't want to adjust your enterprise budget or your provisional billing rates until you know definitively. Those proposed rates may be drastically different than your existing rates, and until that is locked down, for lack of a better words, you would hesitate to adjust the interim and provisional billing rates. Okay. So on the budget template, we have, like I mentioned previously, at leftbrainpro.com, the indirect rate summary and detailed free templates. We also have a budgeting template. It actually works kind of like the bottom up, where you put in your historical data, and then with your chart of accounts in there and your cost pools, you can make those adjustments, whether it be a proposal budget or a forward-looking enterprise budget. You can add those increases in cost or expected changes in revenue once you've uploaded that original historical data. You can do the top-down approach from within the template. So what we're looking for when you have, whether it's our template or any budget template, we have a couple of items here that we want to see in there. Summary of invoiced amount for inception to date reporting. That can apply to multi-year government contracts or just your organization over time. You want to consider that invoicing since either the beginning of a project, beginning of your organization, up to current date. Invoice details, hours and rates by labor category for T&M contracts. T&M contracts stand for time and material. Those are contract types where you are required in the DCAA compliance to list your labor categories, and that is not necessarily your organization. You may have, engineer 1, 2, 3, technician 1, 2, 3, but those labor categories in a T&M contract would be established in the contract. And it may tell you an engineer 2 has to have this certification and this much experience. So you may have an engineer 2 that may or may not meet those same categories. The point being is that you have to go with the contract. That can be, we had another real quick example story for you. One of our clients had a very experienced military veteran engineer, but he did not have, when he came through, there wasn't like a college degree or those professional certifications. So this gentleman was an invaluable part of their organization, earned a very high premium with his knowledge and experience, but they lost money because the labor category that he fit into with his actual qualifications did even not allow for them to bill him at his base rate. Now that is a kind of a specific example, but it illustrates labor categories and T&M contracts very well, because the gentleman was very knowledgeable, very experienced, just a general veteran in his field. But because of his age and experience, they did not have those prerequisites to enter at that time. Public voucher numbers and details. Public voucher numbers would be on the invoicing for your cost type contracts. And that's something when you do the reporting, whether it be to build your budgets or your incurred cost proposals, those public voucher numbers should be referenced, and you should have that in your records. So looking forward, this, I know Robert mentioned this timeline: preparing your budgets in September, approving your budgets in October, submitting the new billing rates. This, I know I previously mentioned myself. You're supposed to wait to receive the letter that, hey, we approve your proposed or provisional rates based on your budget. And then with all that done and completed, and if you did start your budget back timely and met some of these milestones, then you can potentially use your new billing rates updated right in the beginning of January, assuming your calendar year and fiscal year align. So those are very much, we have some clients that I hate to even let you guys know that as of April, they still have not completed or received their letter for their provisional. And that doesn't mean they sent their budgets in timely either. This is a link, which I don't know from our presentation today, but I know they had put the websites and things. If you want any of those free templates, that is a link for those. And we come to another poll question. How much help do you need with your budgets? A lot, please call, a little. I will just use the template, and no, I'm an expert. So this is another one for just for the feedback from you guys. So we've got a lot of folks, almost 80% that have said they think they could take the template and run with it. So that's good. And then the next highest answer, which I think we can probably wrap up the poll. I think we've got most of our responses in there, that, you know, a little, and that they may call. So by all means, reach out to the folks at the PTAC or give us a call or email, and we can certainly help you improve your budgets, start making good usable budgets, or just you know, help out wherever we can. Okay, I think I am a little bit ahead of schedule here, which is okay. But let's open up for questions now. I know we haven't had a whole lot of questions. So right now, I didn't have any, and I do know we are a few minutes early for starting our strategic pricing, and I am going to move back here in our slides and see if there's anything that I can add. I actually did, not even 2 weeks ago, a full workshop this same length on budgets only. So this is one of my favorite topics.
Stephen, do you think you could show the budget template just
Certainly.
briefly?
That's
I mean,
a
not
wonderful
necessarily
suggestion.
go too far, but
Give me just a moment here, and I will get that pulled up, and then we can walk through that.
There is now one question in the chat from John McGuire. Any general advice for the time investment to expect for a new effort to develop budgets and rates?
Okay, no, that's a great question. Thank you, John. But yes, for this budget, I really recommend initially, especially if you have not done a budget before, is to use the hybrid method. And like we said, I will get this, I'm getting to the budget template now, and we'll get that in front of you. But what I was starting to say to this question, you would start with your historical data into the budget template, and then it allows you to identify the cost pools. And that's where you can start in from the top down method and identify if you anticipate a major change in revenue, increase, decrease, then go back through that historical data that you pull. And it doesn't, don't be afraid to pull, you know, if you're starting in September, just as of September data from the last year. So once you get that historical data, you update the revenue, then you can kind of work through the direct on down to the indirects, take into consideration those major questions of does it change the staffing? Are the fixed costs going to be affected? And what potential variable costs of indirects may arise that maybe we did not account for or did not potentially incur in the past.
Sorry, if I could just chime in here on audio. Can you hear me, Steve?
Yes.
Sorry, I guess I didn't word my question very concisely or accurately. So I guess my question is more from a planning standpoint. My particular organization is small enough that we haven't had to have, you know, like a, you know, fully certified cost accounting system, budget activities, but we're like right on the cusp of it. We're willing to grow. We want to grow, obviously. And there's a little bit of debate internally as to whether we should wait for a formal request to do this and you know, then do it to respond directly.
I understand. I understand. And you're talking about the time and actual effort,
right,
that you put in.
Thank you.
So let me answer like this. If you want to do, like, there's the SF 1408 is a adequate accounting system checklist. That is the actual questions and checklists that if the DCAA does require a accounting system assessment, that they would go through. Now, that document is readily available. You just Google the SF 1408. If you wanted to do like the full adequate system, that can be a little longer process because you potentially start with editing or making sure your chart of accounts has expense accounts and places to identify and logically and causally display and segregate the cost pools as well as the direct cost. And then talk about getting back to the timekeeping that can identify the indirect labor distribution. So that is a little more of an undertaking, but if you just wanted to start building a budget and taking your existing data and budgeting it out into a format that would be able to give you some rate calculation, that would not be as significant as a time investment. And one thing we do recommend, even in a smaller organization, is you can't ask the accountant to do the entire thing. It needs to be input from the people, you know, the sales people, the direct labor folks, the ownership. The accountant, you know, they're familiar with what happened, the history, what the trends are, but to really get an accurate picture of potential costs and changes, you want to involve maybe not the whole organization, but representation of each different section department. So that's one aspect that can add a little time, is you do want to involve a larger group. You don't want to just tell the accountant, put the budget together and send it to the owner, because you want to know from the HR aspect, the salespeople, the folks, if they're out in the field, if they're whoever's doing the direct labor, should have a significant input on that budget. And I would think with an understanding and a nice template with the pools set up, you could potentially translate even a non-adequate accounting system data to a budget that could be beneficial. And then with that said, if you did decide, hey, we need to be adequate, like, and we have some clients that, you know, whether it's a subcontract or a SBIR or a SBIRT situation, they need the adequate system and they find themselves in a time crunch. So that is one aspect. And the other part that I really want to add here is in your indirect costs, if you know some point, the near or far future, you will be required to have a accounting system audit. You will be required to report indirect rates in order to calculate your pricing. Excuse me. You can get that set up and put those costs in the G&A portion of your indirect cost pool, that, hey, we're going to spend a couple $1,000s, or we're going to hire a consultant to ensure that our business has an adequate accounting system for DCAA performance. So once you have those costs in your budget or your potential proposal, you can get recouped for that cost that you may spend, because a lot of businesses will say, man, I don't want to spend thousands of dollars to get an accounting system that I may or may not be required to have, or I may or may not need. But if you're in a SBIR, phase 2 is generally a cost type award, which is usually second year. So that can help plan if you're in a program similar to that. And if you do start in advance, you also have that competitive edge where a prime might say, you know, hey, I think you guys are capable of completing this subcontract, but do you have the reporting capability to be adequate? And then if you can say, hey, yeah, we you know, last month or a couple months ago, last year, we went ahead and upgraded our accounting system, then you're ahead of those subcontractor potential bidders that say, like, what's an adequate accounting system?
Yeah, it's interesting. The specific instance we've run into is that although I think we have the appropriate tools in place, just from like a software and tracking and you know, time tracking and all that, we haven't gone through the full kind of rate justification. And so as a subcontractor to a pretty major prime, we had proposed a labor rate, and then they came back and said, well, we think your labor rate's too high. And they just used kind of like a generalized industry-based, you know, system of rate setting to say, this is the rate that we'll accept unless you can justify your rates, right? So we ended up taking a haircut on a contract we really wanted, just because we didn't have that rate justification in place. And
Gotcha. No, and that's where I recommend, obviously, from our consulting and only working with government contractors, we will have a lot of smaller businesses that are in that similar situation. And that's where I really personally recommend that you add those costs and that effort to your proposal amounts, so that not only are you taking the initiative or spreading it out over time. If you know it's a significant task, you can do, you know, break it down monthly or quarterly and kind of spread that cost out. But if you do take the time and foresight to include those costs in your potential budget, then it would roll up into your pricing that you propose. And then when you win the award, not only are you ready for that adequate accounting system audit, but you're also recouping that money that you did spend in advance. Okay, and I do have my budget template. I apologize for the delay there. I think I put my web browser on the screen share, and I apologize as well. So this is our budget template here. No, this is not our budget template. Oh my goodness. I apologize. Yeah. Okay, and it's on I have multiple monitors here and I had a little momentary lapse. Okay. Can everyone see the budget template on the screen here?
Yes.
Thank you. Thank you. I apologize. Okay, so this is what our document actually looks like. This is filled in with some data that is just as an example. So I'm going to move right over to the trial balance. What you can see here, we just have a table set up where we've got your account number, the account names, and this chart of accounts, I just want to mention, we have it set up in a format where direct costs, the GAAP, generally accepted accounting principles, normally your balance sheet, your assets would be your thousands, liabilities, your 2000s, owner's equity, your 3000s, your revenue accounts, your 4000s, and then we continue with that somewhat generally accepted numerology where our direct costs are 5,000 numbers, our fringe costs are 6,000 account numbers, overhead, as you can see, G&A, and then unallowables, we use 9. So we take the chart of accounts from 1 through 9, whether it be 1 point or 10,000, 1,000, whatever your preference may be, no matter if it's a non-accountant, an auditor, a contracting officer, a commercial customer, when they view your financials, they don't have to wonder, do they have cost pools? What makes them up? This logical, something as simple as account numbers allows us to identify the cost pools without having, hey, these are allowable costs. Sometimes we will put a prefix here like G&A labor, overhead labor, which in this one, I don't know if we have, but if we did have overhead labor, oh, it's right here, my correction. So some of those, it all helps not only to get accurate rates and be familiar with your pools, but when you share your data. So you can either upload your data, and this is the budget portion here, where if you put in your historical, you would simply overtype. Now, these are formulas that pull, but you can certainly overtype into these buckets if you know, like rent, if their landlord says, sorry, but we have to raise the rent because of XYZ, you can put that into this budget template. And then over here, it is identifying the 5,000s and bringing them over and displaying on these tabs our direct pool, our fringe. And then on this template that we have, it has the bases so that you can see what makes, and then the applied fringe here. It basically lays out the components just to assist in the preparation. And I skipped over this labor cost specifically. But on this tab, you can actually enter, these are SpongeBob related. I don't know if you noticed, and this gentleman is the creator of SpongeBob, but this is basically, you can list your staff, put in, and these are all just example numbers. This is percentage of labor if they're direct, and then you see like your executives and your accountants and things. Some of them are 0, which that would put them as like G&A labor. But this employment tab is going to basically go through here and help calculate your anticipated costs, calculate your total, like accrued PO for the whole year, and give additional information to help you build that top-down budget instead of just going with the bottom up. So the end goal and result of this budget document is to get, your proposed budget on this trial balance tab. And then on the summary over here, this is the information that is going to come back to with this document specifically. So it's displaying your indirect rates as they're calculated based on the pools. And you can basically, in the event that you did not have your accounts pooled in a fashion that's easy to identify the pools, you would just want to get the appropriate accounts that make up your direct costs over here. Getting back to the summary. These are the adjustable. This goes back to those billing rates, because once we get all three indirect rates calculated, and here you see we have a 15% fee for our calculations. And then these reconciliation portions down here are going to make sure that you get total cost input, that you've got all your financial data in here. And once the rates get calculated, this is the billing rate and hourly rate calculation assistance. So you can see here what they're showing you in column C is a very simple example. If you're billing, if you're paying your staff, this is your gross labor, this $1. That's the amount of fringe that's applied to that dollar, the applied overhead, G&A, and then the fee is based on this, which is an adjustable cell. And this gives you a wrap rate or billing rate multiplier. And that helps you based on your actual calculated indirect rates in order to figure out. And then these adjustable cells, you put in the rate that you currently pay your folks, or that you will hire these folks at. And I'm going to change this fee to 0. And then these same calculations become break even. If you're paying somebody $1 and you're not billing them out at $2.53.6, and these are your actual indirect rates, you will lose money. Then that's making some assumptions that that's the only labor category in your contract and it's a labor selling contract. But then you can see more real life numbers over here you put in. And I mean, obviously for your engineering and professional roles, these could be considerably higher numbers. And then on the indirect rate calculation tool, we have a similar tool that calculates backwards. If your contract says we need a technician 3 and we will not pay more than $80, then you, on the other tool we have for indirect rates, which I can pull up and show you as well, because we do have a few extra minutes. It's going to allow you to put that maxed out rate into like these cells, which would be the input. And then it's going to back calculate based on that billing rate, wrap rate multiplier, what you can maximum hire that individual at. So example, like, let's just say you knew this number was 50 on the indirect rate tool, which I will get open here momentarily. you put your 50 in and it takes this same wrap rate and calculates, which would probably come out to like $20 and change based on this third calculation. So that's some tools in our free tools that can give you both directions, not just I pay my people this, how much do I have to bill them at to break even, or say if I want to earn 10%, that changes. Your $15 an hour staff person based on this wrap rate, which you see their G&A rate is quite high. Not saying it's right or wrong. It's calculated in compliance and accurately, but you've got 280% basically added, which that in government contracting would probably not totally fly, but you probably may not see a 10% fee. You might see a 6 or something like that. So this summary is giving you some of those indirect rate calculations automatically once you have pooled and put your budgeted. And I don't confuse the input with just history, because you can adjust. I recommend too, if you download a tool in Excel that has a lot of formulas like this one here, I would just save as before you start changing a whole bunch of formulas, because you want to have that original template available for your use. And that's just a personal tip. If you download it, save it as the template, and then resave that template as, hey, this is my proposal budget 1 or enterprise budget 10, whatever the case may be, you can adjust these budgeted figures, which can then translate back to these. And see the X lookup formulas, they're going to reference the account number. And as long as you type your account numbers that you want in your direct, it's automatically going to come back to this data pool, identify the numbers you list in column B, and it's automatically going to pull those descriptions and those amounts, which is going to give you your pools with no allocation, no burden. And then by the time you get over to your summary, you're going to get to see your overhead pool and base. We can walk through this here if you want to. This was something when I first started personally in government contracting, I totally got the pools. You know, the expenses are there, you add fringe in a few sessions, but I really struggled personally to understand the base. And the definition of the base and the purpose is a causal and beneficial relationship of the costs and the base that you allocate them over. Now that kind of sounds like cost accounting standards, which it is, but that is easiestly explained with our fringe pool. This are your costs of having employees. So we allocate it over all of our W-2 employees. So obviously benefits of being a full-time employee have a direct causal beneficial relationship with your total employee dollars. Same thing with your overhead. All of your overhead costs should be defined as in support of sales, but not one final cost objective. So you've got all your overhead costs, you apply fringe on your overhead labor, which does become part of the pool. And I like this budget template because it not only does the budget with the rates, but it shows you these burdens and where the applied dollars come from. And then because our overhead is in support of sales, and this is a service industry example, we distribute our overhead dollars or allocate them across our direct or cost of sales, the beneficial causal relationship between the pool elements and the base that it is allocated over. Going back to our first section where I said in the manufacturing, they will often do direct labor and direct material as the base of overhead in a manufacturing scenario. And you can see just from our example, there's almost as many dollars in their material as in their labor. So with that said, if you feasibly double the size of the denominator, that is going to have a drastic, your numerator is the same, but your denominator. So in a manufacturing setting, because of the difference in allocation method, the exact same dollars could even create very different rates based on the allocation method that is used.
Stephen,
Yes.
I have to hop off early, and this was just excellent. We just really appreciate it so much. Roz is going to carry us through the end here.
Oh, sure. And I do expect Robert,
He's
Yeah,
on
actually
now.
here at quarter till, I see we have one question. But that's totally
Yeah.
fine, Deanna.
No,
and
thank you.
wonderful to have the opportunity. Oh, and there is Robert.
Yep, Robert. And thanks to everyone who signed on today. And I just want to remind, PTACs know a lot about government contracting, and we can help you with many aspects of it. You need the professionals for this, though. The Roberts and the Stevens of the world. We're not accountants. And so you really need to, it's an investment to get the right, guidance and technical support for this. So just keep that in mind, and hopefully we can do something together again. And I appreciate all the time today and just excellent information. I don't know if you want to take a break now. That's kind of on the schedule.
That's what I was going to suggest.
Gotta hop off.
Once you do sign off, we will take a small break and then turn it over. Just for Robert, I did finish a few minutes early, and then I took them into our budget template. And I hope that that was beneficial for our audience. But
Okay. Yeah, let's
if
just
we
do
take
a,
about a 5-minute break, I'll.
Oh, yeah, but Steve, there is one question in the chat. I don't know if you want to address that now.
Sure.
It says,
So-
aside from government contracts, are we able to use this for tribal proposals?
Yes.
Yeah.
Is the short answer. We worked with some other PTACs that had a very large portion of tribal clients, and that is totally fine to use the budget template and indirect rate calculations. Just one note here before we do go to our break. If you do update to accommodate and calculate indirect rates, we very, very strongly recommend doing it for your whole organization. Sometimes people will say, well, hey, we're going to keep all this detail for our government work, but our commercial work is pretty simple. That causes more problems, because if you get your staff and your whole organization, we're going to have an adequate accounting system. We're going to calculate accurate and compliant indirect rates. It is incredibly difficult to handle some business one way and some the other. So I would really stress to do your accounting as a organization, regardless of it commercial or government work. So I will switch back to my slides here, and I will be available during the break for any questions that pop up, or other than that, I think I will say at 1:55, we'll go ahead and start the fourth section.
Perfect. 11:55 our time.
Correct. Oh, I apologize. I'm on
Okay.
another time zone.
Okay, go ahead, Robert. You can start whenever you're ready.
All right, let me, yep. All right, so make sure my audio is working there and you guys can see my screen. So again, my name is Robert Jones. Let me get back to my slide here. I'm back for the fourth and final section for today. We've got about 35 minutes left. I do have a lot of material to cover. I would ask that if we are running a couple of minutes late to please stick around. I'll try my best to end on time, and as always, continue to put those questions in the Q&A, or in the chat box, I should say. So we've covered a lot of information today about indirect rates and budgets. We talked about the cost elements and things that actually go into your proposal. So now we're going to talk a little bit about strategic pricing, about how do I actually price out my proposal. And hopefully what you're putting together with all of these pieces is that, right, you need to calculate the rates, you need to kind of understand those costs, you need to understand how the rates flow into and add on top of your direct cost. Steve talked about how to build a budget for your rates, and I snuck in there at the end when he was going through the template that we have and showing you that, you know, it depends on the type of organization that you have, how you would break out your overhead or how you would allocate it. I would strongly recommend that, you know, and it's not just that I'm here to sell hours, it's not about that, but, you know, reach out to us, reach out to somebody who knows government contract accounting, who can help you, because you don't want to think, oh, well, I think this is the way that I should do this. And then you start down a path only to discover later that maybe you've created a real problem. So it's much better to ask somebody, get the guidance and help up front. It's our approach to working with clients. All right, so let's dive into this GovCon strategic pricing here. Our learning objectives. You should be able at the end of our time together to describe market-based or top-down pricing, list the components of cost-based or bottom-up pricing, describe the hybrid approach to pricing, and list some alternate pricing strategies. All right, we've got a poll question, as always here. So what's your level of confidence in your pricing strategy? Again, no right or wrong answer, just trying to gauge how comfortable, how strong are you in your current pricing strategy. So we got a couple of responses coming in. Hopefully we get some more people. I'm seeing lots of people who say I'm pretty confident. All right, so I might challenge you on that. What I should do is repeat this particular question at the end of this section and see if you're still confident. We've got a few more people now coming in, kind of 50-50 on metrics. We have some metrics for developing pricing, but nothing is concrete. So again, for those of you who may be on the lesser side of this confidence, you'll hopefully walk away with some good ideas of what to do. All right, we can go ahead and close that and get into our content so we have plenty of time to cover everything. All right, pricing to win. This is a phrase that you will hear, you know, certainly in the government contracting space. You'll probably talk to some consultants out there and they talk about pricing to win. It means some different things to different people. And what I want to be clear as we go into this section is a few things. Bidding at a loss, silly to win the work, is not a viable strategy. So sometimes people think that, well, pricing to win means if I could figure out what my competitor is charging and I charge less than them and I win the work, then that's a win for me, right? Well, not necessarily. For some of the reasons why. If you win at a low price and potentially even bidding at a loss, guess what? Your clients come to expect that rate or that price. And as you do more work later, it becomes more difficult to raise that price, right? You might, and then again, sometimes what we hear somebody say is, well, I'll bid the first contract at break even or something like that, and then I'll just raise my price later and make it up. Well, it doesn't really work like that. One, if you have a loss on this contract or you don't make as much money on this contract, you can't take that and add it to a future contract. So that's not allowable. But again, more importantly, is what we're saying here is that you also just can't willy-nilly start raising your rates because, you know, if you say, well, I'll just, you know, if I bid, you know, break even or something here, I'll just bid the next one at like 20% profit or 30% profit to make it up. well, guess what? You're going to have to be able to justify those price increases in the future, and that's going to be a difficult battle to win. Number two, getting your foot in the door may not be worthwhile if you don't have the cash flow to complete the work, right? So again, we've seen this happen where somebody will bid a price, and sometimes intentionally and sometimes unintentionally because they didn't understand their rates, but they end up bidding at a price that is either break even or a loss. Well, guess what? Then we don't have enough money to pay the bills, and we might end up in a situation where we don't have the money to actually finish the work, right? And that's going to be a bad situation for you. And the third reason here is that your proposal may be evaluated for cost reasonableness, and you could be excluded from the pool of competition just because your price is actually so low that when somebody looks at it, they're going to say, well, either you clearly didn't understand, what the scope of this is, or there's some fatal error in your pricing that your prices come in so much lower than everybody else. It's always a possibility in this evaluation. All right, I'm going to skip this polling question so we can get on to more of the content here. So let's talk about market-based or top-down pricing. This means that you need to know your industry. You need to know the types of contracts that typically occur in your industry. Are they fixed price contracts? Are they T&M or time and materials? A cost type for the type of work that you do? How are the units of your product or service based? Are you selling hours? Are you selling widgets, right? So are you selling a product of some sort? Are you selling a phase of work or a completed project, right? So as accountants, primarily what we do is we bill by the hour. We have clients who come and say, hey, do you do fixed price billing or fixed price projects? And we don't for one primary reason, and that is that a lot of the work that we do, which is very difficult to put a fair estimate up front that's both fair for the client and fair for us. But you might be in an industry where you say, hey, we will charge you a fixed price for this phase of work. All right, so that might be one way that you price your stuff. Another thing from the top-down approach is knowing your competitors. How are you different? What sets you apart from your competitors? What makes you unique? And only you know that. These are the questions that you have to answer. And I would also challenge you to don't just say, well, we make a better product. Well, we all think we make a better product, or we all think we provide a better service. Do you have something to back that up? Do you do surveys? Do you have, quality reports? Do you have something that you can really stand on and say, look, here's the voice of our customer. Here are the results of the surveys that we send out. Are your competitors focused on being the lowest price out there? Are they on the best value? And so I can tell you, for us, our approach is being on the best value. We don't negotiate our rates. I'm not in the business to win somebody's work just because they want a lower price. It's just it doesn't work out us or them in the end, because now we're here in a situation where we're performing the same work that we perform for other clients, but we're getting less money from you to do that work. Then again, to some of the things I was saying earlier, you get used to that kind of price, and then you expect me to honor that price long term. And it's just a situation that never really works out well. So that's why we focus on best value. We're not the cheapest. We're also not the most expensive. We're pretty in line with our market. We know what we do and we know how to do it. We can stand on that. We have, when people ask for referrals, we have great referrals that we can do to people, we can provide to people. And we can show that, hey, you might find somebody cheaper, but do they have the specific experience and qualifications like we have to do the work? And that's one of the ways that you sell best value is, you might find somebody who's cheaper, but do an apples to apples comparison. Do they have the same type of equipment? Do they have the certifications? Have they performed that exact type of work or product that you're looking for? You need to know your current market conditions, right? And obviously the supply chain over the last couple of years and continues to be a real problem. Actually, the client where I'm at right now, that's one of the things we're working on is some supply chain issues with them. But what's going on? Is there a surplus or shortage? Excuse me. Is there a shortage or surplus of your goods or services in the marketplace? What's going on in the overall economy? Our overall prices going up. You know, are we seeing, you know, obviously during the pandemic, you know, we saw a lot of industries where, you know, people stopped spending money, and it's not that they didn't need the service necessarily or need the product, but it was like, hey, there's too many uncertainties going on. I'm going to hold on to my cash for a while until I see, you know, what continues to happen in the marketplace. Again, I'm going to skip over, I'm going to save some of our poll questions for the end. Let's talk now about the cost-based or the bottom-up pricing. This is really the heart of a lot of what we were talking about earlier in terms of understanding your direct costs, where we talked about those direct cost elements of labor, material, travel, OECs, and subcontractors. You know, the other part of your cost base are the indirect rates that Steve went over. Let me catch up to my slide here. I got ahead of myself. But your indirect costs that Steve was talking about in terms of fringe, overhead, and G&A. And remember that your indirect rates are built on a set amount of direct costs. There is a relationship, as he was showing, and again, there at the end of his last section when he had that budget template up, and he said, hey, you know, if the nature of your business is different and you change, you know, this denominator, that's going to have an impact on the rate. So that's where, again, what I was saying earlier, if you remember before I departed, and I said, you know, commercial companies oftentimes have cost of goods sold and there's all other overhead. And if you take that all other overhead and you break it down into this fringe, overhead, and G&A, and you begin to understand what's in the pool and what's in the base of each, and you understand that relationship and what's going on, one, that what you'll see is that direct costs are the primary driver of the other pools. And so as a business, if you see that your direct costs are going up or going down, and you at least understand why they're going up or going down, then you'll be able to know and predict what's going to happen as well to your fringe, your overhead, and G&A. Some things that affect indirect rates, as I just said, this increase in direct costs results in a decrease of indirect rates overall. Again, so if my direct costs are the primary number or figure, that the denominator, and the base of my rate, right, the denominator gets bigger, then what's going to happen? The overall rate is going to come down. So increased direct costs is good overall. That means that we're doing more work, right? I've got more billable work to my customers and my clients, and hopefully we have little or no increased indirect costs, right? So hopefully I can do more work and pay my employees more money, or spend more money on materials, but I don't necessarily need to incur any more overhead or G&A. Now, obviously, there is a point where that, you know, no longer applies, right? So we could be going along and say, do a little more work, I do a little more work, I do a little more work. Well, wait a minute, I can only do so much more work until, wait a minute, I have to hire another overhead person, or I have to, you know, buy a truck or something. So we do begin to see some increases along the way. But again, understanding how those things work are going to help you understand your rates. So if what I just said is the increase in direct costs results in an overall decrease of indirect rates, then the inverse is true. We have an inverse relationship. So if my direct costs are going down, so in a period where maybe sales are slowing, certainly during COVID, especially 2020, when things were really crazy, you know, we saw a lot of clients that their indirect rates went up significantly. Why? Because they were, you know, there were stop work orders. They couldn't go, you know, to a government facility to execute the work. There were various things that were happening. And so all of a sudden, you know, they're going along, and now the direct work they were doing begins to fall off. Well, guess what? Oftentimes your fringe, your overhead, and G&A are fairly fixed and steady costs. So those are remaining, and now I'm spreading them over a smaller base or a smaller denominator. So now my indirect rates are going to go up. And if you understand that basic, and you can sit and you look at what's happening today, and you look at your forecast and say, hey, we're seeing, or we're expecting an increase of sales, or we're seeing or expecting a decrease in sales, you can be, in your brain, you're going, okay, now I know what's going to happen to my indirect rates as I look at these other reports. We talked about this part earlier about winning or losing a big contract affects your indirect rates and why you need to update those proposals. It's going to have an impact on your pricing structure. As I said, if you win a large contract, your direct costs are going to go up, which is decreasing your indirect rates. But you also have to stop and consider, is this a major proposal where, hey, I have this contract, that's another $1 million worth of work. I got to hire 10 people. I've got to rent another facility. I got to do these other things to be able to execute that work. That's where we have to, think about those things as we look at our rates. And I'm going to mention this earlier. When I was saying about kind of defining what a major contract or a major proposal is, and that's why I said 20%, just my gut feeling of how we operate, of how I know a number of our clients operate. We can always, take on more work without spending that extra money. And we know we can absorb some of that. Now, what if you outgrow a single indirect rate model? We talked about some of this earlier as well, where I said, here are some things to look for and be thinking about. If you've got a growing or complex organization, you probably need to start thinking about that, what we either refer to as advanced or multiple indirect rates, meaning that I might be splitting out fringe, I might be splitting out overhead, I might be creating a material and subcontract handling pool, I might be doing any combination of those things, right? There's no right or wrong answer of what an indirect rate structure should look like, other than it does need to match the operations of your business. So if you've got like an engineering and a manufacturing part of the business, then you should have an indirect rate structure that identifies my indirect cost, my manufacturing costs and my engineering costs, right? And have rates that build into that. All right, let's do this room poll. And I apologize, Rosalind, I might have gotten you off course here on my polls. So which statement here is true about indirect rates? And I will let you read those and think about the answer. It might be a little bit tricky. So which is a true statement about indirect rates? Everybody's thinking, because I'm not seeing any answers yet. So we've got a couple of answers, and I will say they are the correct answers so far. Got 7 people. You guys are doing pretty good. You're paying attention. I appreciate that. We'll give you all just a couple of more seconds to answer. And I do want to make sure we have some time for questions at the end, so we can go ahead and close this poll. So the correct answer is D, David. And let me just do a quick refresher as we go through this. Most of you got it correct. There were a couple of people who got it wrong. So remember when we were talking about indirect rates? If I have an increase in direct cost, which is usually the primary driver in my denominator or in the base, if that base gets bigger, then what happens to the rate? The rate comes down. So B, the inverse is true. If I have a decrease in direct costs, or the base and the denominator gets smaller, then my rates go up. Winning a large contract decreases your indirect rates. And I'm sure another accountant out there would probably challenge me on this to a degree. But again, largely we can win more work, thereby A, increase direct costs, decreasing indirect rates. So D, David, is the correct answer here. All right, let's talk about this hybrid approach to pricing. This is what I really want to get across, because this question here is the question you need to be able to answer. Can I sell my product or service at the market rate, right? So the market rate, remember, was that top down. What are my competitors charging? What's happening in the marketplace? Can I sell at the market rate and make money? Well, what does it mean? That means that whatever my selling price is has to be more than what my costs are, right? So my costs are the bottom up approach. So that's what hybrid is, right? I've got to look at both. I've got to say, well, what are my costs to deliver that product or service? What is the price that the customer or the market that's willing to pay? And is there a difference between the two? And is it enough of a difference for me to be willing to do that work, right? So that's one of the important questions. So the pitfalls of a single approach, if you only look at the top down, and we see this happen, we've had people come along and say, well, we know that we can only charge $120 an hour, so that's what we've been charging. Well, guess what? We calculated their indirect rates, and your indirect rate, if I roll up all of your stuff, it's actually costing you $115 an hour to do work. So you're only making $5 an hour as the owner of the business on all of this work. Is that enough money? It might be, it may not be, right? That's really, 5%, if you're looking at 125, I forget what I even said, but if it was $120 and found out it cost you $115 and you're only making $5, you got about a 4.5% profit margin. That's not a very big profit margin, and doesn't leave much room for error. We've also seen the situation where they're charging $120 an hour and come to find out it's actually costing them $130 an hour. So it's actually costing them more to do the work than what they're charging for it. So if you only look at the top down, you may not leave enough room for your desired profit margin or any profit margin at all. If you look only at the bottom up, and I do have to pause here and say that we have to be careful on this part, because in a cost type contract, it really is just the bottom up. It's going to be the bottom up plus whatever, whether it's a fixed fee, award fee, or an incentive fee. But otherwise, from a bottom up perspective, when we look at the T portion or the time portion of a time and materials contract or a fixed price contract, we got to, again, marry up this top down, bottom up approach. If you only look at the bottom up, you might actually be leaving money on the table, right? If you calculate your costs and you say, hey, well, it cost me $100 to do this, I'll bill it at $110 and I'm happy making that $10 profit. Well, what if the market is paying $120, right? What if you could charge $120 and actually make more money? That's why it's really important that you understand both pieces of the puzzle. So let's do this polling question here. Which of the following is a pitfall of a top-down only single approach? See if you were paying attention on the last slide. What is a pitfall of a top-down only single approach? So we've got 4 people, and most of you are correct. So remember, top-down approach. What's the pitfall? All right, we want to go ahead and close this poll, please. So the pitfall of a top-down, right, is A, my costs might exceed my market price and not leave enough room for my desired profit margin. That's the problem if I only look at what the market is paying, what the market is doing, or what the customer is willing to pay. And let me give you a quick example. So we had a client that came on board, I think early last year, and they came to us in the industry that they're in and the relationship that they have with their prime. And we see this on a regular basis. Oftentimes primes will say, we're going to sub out this work, but we're only going to pay this rate. Basically, the prime has identified up front, this is the most money we're willing to pay for this. And the situation with this particular client was that, hey, we're being forced into accepting this rate, or if we want the work, we have to accept the rate that the prime is willing to pay. But we're looking at our costs and we're saying, we either can't deliver it at that price, or we certainly can't make the profit margin that we should be making to deliver it at that price. So in that situation, that becomes a great strategy for us in helping them figure out, well, how do we reduce your costs? What can we do so that if you are going to accept that work and bill at that price, how do you maximize your profit in the process? And that's one of the strategic things that we often do with some of our clients. So what are some alternate pricing strategies? How can I improve my profit margin? Well, one would be to increase price, right? If I could just say, well, if I'm not making enough money and I want to make more money, what do? Well, I raise my price. We can only do that to the extent that the price, one, is fair and reasonable. So let me again pause here for a moment and say, We always have to remember that the contracting officer or the prime always have to make a determination of fair and reasonable. You can put any price out there that you want. You know, everybody else is charging $125 an hour, and you say, well, I want to charge $175 an hour. I mean, maybe you'll find somebody willing to pay that. But, you know, when somebody's doing their market research and you've got competitors who are submitting bids for $125 an hour, guess what? You're not going to win the work. You know, number two is I need to lower my cost, right? If I'm already at the max of what the market is willing to pay and what my customer is willing to pay, then what can I do to lower my costs? And that falls into a couple of buckets, right? I need to figure out how can I reduce my direct costs. You know, it's one thing to say, well, maybe I pay my people less, especially in this market, that's not a realistic thing. But, you know, how can I source my material, right? If maybe I'm doing manufacturing or assembly work, can I buy material in different quantities or negotiate different rates for stuff like that? What can I do to reduce my indirect costs? So there are a couple of things around that. One is, as we've talked about before, if I can get more direct work overall, we know my indirect rates will come down. But it's another strategy is, okay, what do we do? So perfect example with another client, and again, we've done this many times, but an active one that I'm working on right now, we are not necessarily reducing their indirect costs, but because we're breaking apart their overhead pools into multiple overhead pools, we're now actually reducing some of those indirect rates that better align, and now they can sell more of that particular product or service. And the other products and services that they're actually selling at a more appropriate price. It's a higher price, but it's a more appropriate price that they're now achieving total cost recovery and maximizing their profitability on that, while at the same time becoming more competitive in these other areas because they've lowered their price. And so now their customers will say, hey, well, now I'm willing to buy from you because your price is more in line. Well, that begins to have a domino effect, right? Because now if I can continue to sell more of this other work that's more competitively priced, what's happening? My direct costs are going up and my overall indirect rates at least are going down. Maybe not my indirect costs as the number in the pool, but my rates come down. We do also strategize with clients on how they actually reduce the indirect costs, the actual amount of the dollar that's going in. So we can look at things of, you know, how you structure your fringe benefits package, how the money that you're spending in overhead, the money you're spending in G&A, and we do get into that kind of work as well. You might look at your product and service mixes and how your pricing might be adjusted on individual items in a complex proposal. So one of the ways that I describe this that some people understand, hopefully many of you will understand this, when you get the weekly flyer, if anybody actually gets their weekly flyer anymore from the grocery store, right? They always have there's always something that's on a really good deal. And I remember growing up and where I grew up, it was pop. I now call it soda. It was pop where I grew up. And I remember that we would go grocery shopping that week wherever pop was on sale. And pop oftentimes, or soda, whatever you like to call it, is often what they call a loss leader in a grocery market thing. And there are a number of other products like that that are loss leaders. And I'm not telling you to price your stuff at a loss, but they lure you in, you know, because, hey, people want to buy pop. I've got the cheapest pop. Well, guess what? Somebody's going to come here. Well, if they're going to come here for pop, what else are they going to buy while they're here? Well, they're going to go ahead and buy meat and bread and milk and a bunch of other stuff. And guess what? I might be able to keep my margins up on those things. And so the overall product mix, right, the mix of stuff that's in somebody's cart when they walk out the door, yeah, I might have broken even on the pop, or maybe I lost a few pennies on it, but look at the money that I made on the other stuff. You got to be very careful with that. Again, I would never tell somebody to price your product or service at break even or at a loss. But we do have some clients that the nature of what they sell, they might sell product, and with it, they sell some installation and training services. And so what they might do is actually look at how they price each of those and say, you know, maybe I'm willing to take a smaller profit margin on this piece, knowing that I'm going to actually sell more of this and get more of a profit, get more profit over here. Perfect example, we have, I know somebody that sells software, And so they have to do some training and installation. Well, they're much more willing to negotiate the price on the training and installation because that's a one-time upfront thing. Where they make their money, right, is on the software license. You have to renew that every year. So they're willing to kind of take a hit on the front end and maybe deliver the training and installation at break even or at a very small profit margin, knowing that in the long term, I'm going to continue to sell the software and that's where I'm going to make my money. Again, this is helpful where you have those complementary products or services, add-ons, or something again where maybe there's some type of subscription model involved with it. All right, let's talk about adjusting profit or fee. So we've iterated this a lot about adjusting about what the effect of direct expenses have on your indirect rates. But what do you do about reduced profit or fee? So this is again where we have to be a little bit careful and think this through. Overall, similar to a product mix, I could have a contract mix among my government and commercial work and among a mix of contract types. So for example, your fixed price contracts should have a high profit or fee built into them because there's a higher risk to you as the contractor. So there should be higher reward in terms of a higher fee. Cost type contracts have less risk to use the contractor, so they typically have a much lower fee, usually in the 8 to 10% is what we see, sometimes even lower than that, but hopefully in the 8 to 10% range. As an organization, you might do a mix of those, right? You might, some of the work and some of the contracts we have is cost type, and maybe we're only making 8 or 9%, but we also have these other contracts, and they could be for the same or similar services. Some of them could be with commercial entities, some of them could be with state and local or with federal government, some kind of mix of stuff. And so overall, I might say, well, my overall profit margin of my entity, maybe I'm shooting for 12% or 15% or whatever that is. I know when I do this work over here, I'm only going to make 8 or 10, but I know if I can do more of this work, I can get 18 to 20% as an example. So another way to think about how you price again your product or service. So when it comes to negotiating prices, be careful and never negotiate on profit or fee alone. If you've put out a total price for a project and somebody comes back and says, well, I want to negotiate the price, guess what? Then we need to negotiate the scope, right? Because if you just say, well, whatever, let's say I bid $50,000 of fee or profit into this thing. Am I willing to shave off, whatever? The customer's asking for some kind of discount. Well, if I just shave off the top, well, guess what? I'm just shaving off my profit or fee, right? So that makes it, more difficult for me to achieve my internal targets. If your customer wants to negotiate overall price, then they need to be negotiating scope as well. And that could be the amount and the type of work that's being executed. It could be schedule, right? So maybe you'd be willing to reduce the overall price if you had more time to do the work, right? Maybe they had an aggressive schedule and you said, okay, in order for me to do the aggressive schedule, like I'm going to have to hire more people, or we're going to do overtime, or we're working weekends, or whatever it might be, to get the work done. And you might say, well, if you can give me an extra month or 2 months or whatever it is to do the work, and I don't have to pay overtime and do this other stuff, right? I might be willing to do it at a lower price. I might be willing to offer an extended warranty. That's a common thing that we saw in my background selling product to the federal government, is that we would negotiate a longer warranty period. Now, there certainly is a risk and there is a cost that goes into that, because you have to be able to account for that on your balance sheet. And I won't get into the fun details of that. But the cost of extending your warranty really is relatively inexpensive. And again, it's a great negotiating point when we come about talking about pricing. So we've covered a lot here. Again, there's no right or wrong answer in terms of pricing, other than obviously we really do emphasize the importance of hybrid pricing and understanding the top-down market prices and the bottom-up or the cost portion of your stuff. Remember that, as the business owner, it's always at your discretion to lower or raise the prices or find the ways to perform the work at a lower cost, right? So we look at, again, back to the contract types, in a fixed price contract, the incentive as well for you as the business owner or manager is to figure out, how do I deliver this product or service at a lower cost? Now, it needs to be the same quality. I got to deliver it on time, right? It's got to meet all of the specification. I want my customer to be satisfied with what they get, but is there a way for me to actually deliver it at a lower cost? Because if there is, guess what? Then that's more profit for me as the owner of the business. All right, so I think this is our last polling question. Let's do this. I got a couple other slides I want to get on the screen as we finish out the day. Make sure you guys can contact us if you've got any questions. Get them in the chat. Question here is, given what we covered, what's your comfort level on pricing for profitability? So we've seen a people, I'm seeing some I've got it now, which is good. I'm seeing a couple of people that say I'm fuzzy or I'm unclear. Again, if you've got questions, so what I'm going to do is go ahead and start advancing, get my slides over here. So you have our contact info. And when we close out this poll here in just a moment, you guys will see our contact info on the screen. I had put the email in the chat earlier. Again, it's support@leftbrainpro.com. That goes into a help desk, and we've got 3 people on this side who be monitoring and answering that. You can find us on social media. We do monthly webinars. So if you go to our website, I clicked something, there we go. If you go to our website and go to the events section in the top menu bar, you'll see that we do monthly webinars on some topic of government contract accounting. If I go back in my slides here, my slides went away. Hold on one second. Get this slide back up. I clicked too far and it went out of presentation mode. There we go. What was I gonna say? If you go to our YouTube channel, we have, I think, 38 videos out there right now, anywhere from 60 to 90 minutes long. And we have, some of them are going to be repeats of some of the topics that we did here today, but we have a lot of topics out there on government contract accounting. And you can watch any of those for free by going to our YouTube channel. And you can just go to YouTube and search for Left Brain Pro and you'll find us out there. So with that, Rosalind, I don't see any other questions. I don't know if anybody wants to unmute and ask any questions.
Yeah, feel free. Type it in the chat, unmute yourself. Now's the time. We've got some experts here. Some of you might need to let some of this digest. You'll probably have questions later.
Sure. Yeah, don't hesitate to ask questions. I can't say that our services are free, but I'm often very happy to answer a short question and point you in the direction. And if you do decide to engage with us, one of the things I always like to let people understand is that, we understand we're a small business. We understand what it means to be in a small business. We can help you on a bite-sized approach towards compliance and towards improving your profitability. All right. Well, not hearing any other questions. I don't know if you've got any closeout, Rosalind. I do want to say thank you for the opportunity to participate, and hopefully we can work with you guys on some presentations in the future.
Yeah, this has been amazing. So thank you, Steve and Robert, for doing this. And thank you, everybody, for joining us. I hope you learned a lot. I'll send out the slides and I'll get a link for the video. It'll be on our YouTube channel. And I'll get those. We'll figure out the templates. Some people were having trouble downloading like the budget template.
Okay.
I think I can
if you have
send them out. So
okay. Yeah, if you have any trouble, just let us know.
Okay, well, if that's everything, thank you so much again, and everybody have a great day and good luck with your accounting.
Thank you, Rosalind, for
All right, take
having
care.
us.
You're welcome. Bye.